Step up, traders, time to roll. Numbers shaking down the scroll.
What do we got here?
Clock is ticking, you already know. Welcome into the stock market show.
Test 1, 2.
Oh, yeah. Monday to Friday when the floors are live. Captain Jim James help you cut that dry.
1 minute remaining for the Bank of Canada rate decision.
Charts are jumping, green and red glow. He's steering this ship on the stock market show. It's a stock market show where the bulls run wild, the bears lay low from
Check 1, 2.
till the closing go. Ride that wave on the stock market show.
Check 1, 2.
Got your watch list ready, got your game face on. When the spreads get heavy, he keeps you calm. From the open roar till the last trade goes, he's calling the shots on the stock market show.
10 seconds.
Hey, it's a stock market show where the bulls run wild,
Check 1, 2.
the bears lay low from the first loud bell till the closing
No change, no
Ride that
change.
wave on the stock market show.
5% as expected, seemingly in great shape. But now, Bank of Canada say they will not allow the effect of become persistent inflation. The bank will look through the war's immediate impact on inflation. The longer this conflict lasts and the wider it gets, the bigger the risk.
Get that trigger
The risk that energy prices quickly spread to the prices of other goods and services looks contained, according to Bank of Canada's macro. Persistently higher oil prices, though, would boost
I might.
money for spending as well. Labour market remains soft, and recent trade data suggests ongoing weakness in exports. Macron adds that uncertainty is inflation is a dilemma for central banks. Bank of Canada note that the recent data suggests near-term Canadian growth will be weaker than anticipated in January. They say the sharp increase in gasoline prices will push up total inflation in the coming months, and risks to growth look tilted to the downside. Inflation risks have gone up. Middle East conflict will boost.
We're on. Sweet. You're good. I don't need John.
Potential economic impact of the Middle East war is highly uncertain. But
I know who that is right there.
heightened risks to global economies, and financial conditions have tightened from accommodative levels. And it's too early to assess the impact of the Middle East conflict on growth in Canada. We have the Bank of Canada's rate statements on the feed for those interested as well.
Voice news disconnected.
So today is FOMC day. We've got a busy week, of course, ahead of us. We have Vixperation today. We have a rate decision today. Let me see if I got all this right. We have a rate decision today. We've got the war going on in Iran. FOMC rate decision. And did I sell that right? Hold on a second here, guys. Sorry about that. I've got some noise going on in the background, so I apologize here. I also have my my trusty light over there that's making it look like the sun is glowing in my face right now until I fix my camera or fix my settings on my camera. So today, everything good? Cool. Today we have Vixperation, which of course is normally or usually is a doom day. And as a matter of fact, the last few Vixperations we've sold early. I think we sold this morning, starting at 8 a.m. That's a very common thing for us to do, sell down into Vixperation, and then park sideways for the rest of the day. Now, today we have the added sugar of FOMC. FOMC today as well at 2 p.m. And then we have the actual statement. And then how you guys do? You guys okay over there? My dogs are going off right now. We have the statement at 2 and then the presser at 2:30. We also have Iran happening at the same time as some backdrop. this morning, I was waiting to see what what would be assigned to the drop this morning, and of course they blamed it on Iran, but it's not Iran. It's just Vixperation. It's every Vixperation. When we get that contract roll, they try to bleed out if the VIX has been murdered down into, let's say we're going up, VIX gets murdered down into the contract roll, and they spike it up. And then also when we get into the if we're heading down in the market, and if we're heading up into Vixperation as we have been all week long, that contract rolls on a low, and we try to get that VIX running for the next month. And this isn't the end of it. We have, of course, Iran in the background, and then we have QOPX, quarterly OPEX on Friday, triple witching. And then we roll into the end of the month and next week and thereafter, and we're still dealing with Iran and all that kind of stuff. So a whole ton of stuff going on in the market right now, and we're going to take a look at it right now and just see our plan for the rest of the day today. Top line on FOMC, I couldn't see anything over the past auctions on the yield on 3 and 6 months indicating that you're going to get any kind of a cut or a hike today. We'll talk about some reaction functions, and we'll discuss some of the noise from the street and the journal for this event later this afternoon. To me, it's a non-event. With so much going on right now, the market is very wound up into Vixperation, QOPX, month end to some extent, or the market cannot unwind as much as you really want to see it unwind until all this stuff sort of passes. And I think it doesn't matter if it's I don't want to say it doesn't matter, but the market's so wound up over the course of a quarter, and then every month thereafter that these options are going to go to die. There could be like a nuclear war, and it wouldn't matter. This market wouldn't move as we get closer and closer and closer for an unwind into, you won't get a big unwind until after we get past some of these events for these options to die. So we'll take a look at it right now. Let's shift over. We're going to start with, just make sure I got this right here. We're going to start this morning with, if I have my notes here somewhere, I'm writing these notes down here. We're going to start with the setup for today, and then we're going to move into the gamma on the intraday gamma. We'll look at some stock picks, some economic data, including the events later this afternoon. And from there, there's something else we got to do, but it's not on my list right now. But there's something else we got to do later on, so we'll take a look at that too. I guess we'll keep that as a surprise or a hook to keep watching the show, and we'll look for some positioning and stuff like that for you today as well. So this is a pretty big day in the market, right? Normally, this is the highlight of the quarter. We're going to look at trend and breaking trend, that kind of stuff, if we can break trend or not. I wouldn't expect much right now, guys. They're going to, normally on Vixperation day like this, we'll sell down, we'll pin, and trade sideways. Now, can we get an unwind on the Fed maybe at 2 p.m. To go further down? Possible, but I'm not going to bet anything on it at this moment. So we'll take a look at the couple different outcomes here and see what it turns into. So the first thing we're going to do here is SPY expectations. We're going to take a look at this together here. Now, right away, just looking at candles, nothing else, right? Just looking at candles. I would bet here that the thesis is just looking at this, hey, we've broken trend. We've broken trend with Vixperation day. We're going to go up here and clean all this out, and then maybe we can start going higher or even blast down through this and then head lower. So these two outcomes right here, when you're looking at, if we're not in a binary event, right? If you're not in a binary event, or Vixperation or QOPX or any of this kind of like options dying stuff, just looking at this price action all on its own. Let's look at this right here. Just looking at this, hold on a second here. What's going on there? Hide all. Just looking at this right here. Nothing else. Not knowing anything or whatever you would expect. Looking at inflection points, we went up to the 674, and we broke support, right? So the idea here is that if you have more, I mean, I know this sounds stupid, but if you simplify your life and just say more sellers, more buyers, right? There's the more sellers, there's the more buyers down here. and you were told no go, right? So the first thing that you would think to yourself is, hey, we broke this right here. We're going to reject, make a new low down here, and then make our way at least to test this prior low. But more than likely, we'll break through this and start making some new lows to the downside. That would be the expectation. But we are not in normalcy. We are in Vixperation. And I know that everybody out there wants to say, yeah, it's because of Iran or this or that. This is literally every single Vixperation, no matter what. No matter what. They're resetting and contracting or rolling a contract for volatility. This is to be expected. So do we have continuation to this downside? Because of expiration, I would say there is no guarantee that we go down here. And there's definitely no guarantee that we continue to go to the downside, even if I'm going to chart that for you. The far more likely scenario here is we park sideways. I'm just going to let you know right now. Park sideways, we do literally nothing all day long today, and then grind higher and higher and higher and higher to get past OPEX and or QUAPEX, and then we begin that unwinding heading into. Let me just move this over a little bit. Far more likely is that we go sideways, we pin into QUAPEX, if not even just pin right down here, and then after this QUAPEX and closer towards the month end, if that unwind is going to take us down, we'll head down that way. Then, if there is anything like that, that's what I would expect. That it would take some time into the month end, if not even the week after in April, to head to the downside. So we'll look closer at that as the day progresses here. But let's take a quick look at some expectations and just see where that lower target is and how do we get there, and can we get there? Can we break trend? And we're going to start right here. And the first thing that I want you to see here, it's very simple. The market stays in hold on here, guys. The market stays in trend. You can see trend is right about here, right? And when we come into monthly expiries, quarterly expiries, if you're going to change trend, I don't care if it's down, and I don't care if we're going down, we're trying to break trend to go up. You need some escape. You need some escape velocity on monthly, quarterly and month-end expiries, monthly and quarterly OPEXs, QUAPEXs, and month-end expiries to try to break that major trend. And in this particular case, we are breaking major trend to the downside, and sellers want to break trend convincingly and stay far enough away from this trend as we come into QUAPEX and month end, wherever that is over here. The farther away we are from this uptrend, the more continuation we can see as the unwind from this quarter of option activity takes place. If the market gets sucked back up, if the market at any point gets sucked back up into OPEX or month end, we're back into trend, sentiment and then positioning, and then even the negative rolling of hedging in the market won't send us low enough to keep us out of trend. Sentiment can improve. Like you got the dealers chasing negative flows on the end of the month, end of the quarter, down, and then of course once they're done chasing those hedges, they'll counter that trade, put us back up into trend, and we stay heading to the upside. So if you're a seller, if you're like got doom on your mind, any of that kind of stuff, or new lows, you want to see the market stay away from major trend, down and away from major trend. The first opportunity for that to happen is Vixperation. The second one is is QUAPEX or OPEX if it's on the end of the month instead of the quarter. That's this Friday. And then month end on the last day of the quarter or the month. Of course, we have that coming up here for the month of March. And if you have sprinkle a little bit of salt and pepper, some seasoning on there, maybe the Fed sometimes or Iran could lead or help that continuation or that pitting to the downside to try to keep the market down and to keep that volatility for these new lows. And even if you can't get it today, Even if it's a matter of like grind, if you're still underneath that major trend, and then we get hit with that tape on major hedging, which is always bearish, you can maybe start to have a little bit of an unwind to the downside in the beginning of the month down here, where you think you're going to get it right here. You have a bunch of catalysts in here, and even if it takes into first week of April or something like that, you can try to get that downside move that you're looking for. So, market is wound up right now, right? We have Vixperation, the first expiry for the week. The first target that's down below is this monthly here. Is it win the month there? That's a week. We'll change this up. We're going to go and look at the week here in just a minute. Actually, let's just switch over there right now. We're going to go from candle to candle. There's your week. We're going to start at the month. Let's start at 3 months really quick. Let's look at this one right here. And this is the key right here. If you look, this is a 3-month chart right here. This is up here. This is the 3-month candle. Down here is the prior 3-month candle, right? The prior quarter. And this is this prior quarter right now. And if you're a seller, you want to see a low that takes out at least 80% of this prior candle right here. So we're going to measure this together. We're going to look at this prior 3 months. Got that right? Yeah, I think I do. Right in here. This prior 3 months is 6.22%. And we're going to raise this up to 5.100 right here. Did I get that closer? A little bit closer. Right there. That's close enough. We want to snap this line right here. Wait a minute. We're going to make this line white right here in this 3 month. Let's get rid of this this weekly for a minute here. And the reason that I want to show you this 3-month candle is that there's a lot of door opening down below if price can get down there. So like, why do sellers want to get down deep? And the reason they want to get down deep if they can, they want to trigger this one right here, is to open a door even lower to 632, 630s, 620s, and beyond. Excuse me, to go down even deeper. We haven't done that yet, but I want to I want you to see this level right here. There's an important reason to see this 656, and I'm going to show you why here. Why do the bears want to get down there? They've had 2 chances to do it. 2 chances to have a bloodletting to the downside. Why do they want the bloodletting? You'll hear these sellers and bears say, "We just want to get paid, bro." They don't want to get paid. They want to open doors to go even deeper down into the market. It has not happened yet. So we're going to write 3 month right here. And there, I'm going to show you where the trap is. The trap here for buyers, for bulls, and what the, like, whenever you listen to a seller, they'll say, "Bro, we just want to go back and close that gap, man. I just want to close that gap, bro." Or I want to go back down there and just sweep that low, man, really quick. And they don't really want to do that. They want to unlock more lows, bigger sell side lows. And that number right now is 356.42. If you go to a 1 month, I'll start to show you where that target is for the monthly. This is what everyone's looking at here. Can we trade this monthly right here? So why do people want to trade this 1 month? We can just do month. That doesn't matter. 1 month works. And I want you to look at this now too. I'm going to move this to the side. And you start clearing out all these candles down here, right? To get to this monthly, you're going to break this 3 month. That automatically opens a door. You slam down here. And even if you circle up here and squeeze on a cross, it's not going to matter. Well, not matter, but the impetus here is that you've broken a doorway to the prior quarter to open a door to go even lower to the 30s, 35, 20, and of course continuation to 6,000 or even lower. So this is kind of important. This is very important right here to be watching, in particular, this 3-month right here. And this 3-month also is more than likely 80% of this monthly candle where all the bulls are down here. So you're down here erasing all of this stuff down here. You trigger the door to open lower, and then you start erasing these candles, and all of a sudden you've got the 630s, right? We're starting to look at 630 down here, and then even lower to 620. These candles over here for the prior quarter all open up for the sell side or the bears or whatever you want to call those guys, whatever you want to call those guys. If you look here on the month, target 648.36. If you look at the weekly, it's the same place, a little slightly higher. But this is where this right here is what the sellers want. They want that door open at 650, 642. And there's this trigger down here where a bull would think, hey, if we get down here and trade, 648, then we trade, like, I'm okay to go down here and hit this thing, but in reality, when you do that, you actually trigger a door to, even on a squeeze all the way up here, you've opened a door to go even lower in the month of April and maybe even beyond into May to the downside. So there's like a hidden bull trap in here, okay, if you will, hidden bull trap. If we trade this 656.42, if we break through it, doesn't mean it's going to happen, but it's like a key. We opened a key. The bulls don't know it. Bulls thinking, oh my God, we're going to bounce. We're going to go up here. We're out of here. No big deal. And they're not paying any attention to this hidden unlock, key unlock to the downside, which actually turns into more continuation to the downside over here. So you want to pay very close attention to 656.42. 656.42. And there's something else important here too. This is this upper target right here, 675.10. And I want you to remember this one as well. You want to be watching this one. And we're going to go to the day. These are all like doorways below. It's not necessarily like a doorway below, like we smash into it and then it's, down like so. You can get a nice big squeeze in here before we go down. The same thing applies to the upside here if you get above this 675.10 up here. And there's another target slightly above it at 678. What you're doing is you're creating a trap for bears. So even if you come down here, if you've triggered, there's one more above here somewhere, what happens is this holds and then we make our way higher. So there's these hidden doorways both up and down for bulls and bears as we diddle in the middle here. That can give you some insight into continuation down or a move higher. So we're going to look at this one right here in the daily. We're going to put this mark right here. This is the you shall not pass from sell side right here. Trying to tell you not getting out of here. There's one D. There's another D right there. And you can see right here, all of this like doom, down, 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 down. All these daily lines that I'm drawing up here all matter. And there's one more tick above here. I don't know if you can see it, but there's a daily tick right here. For the bulls to be out, 1, 2, they need to trade above 690.15. If they can, so on the upside, it's 690.15. And that would signal that even if we come back down, we're going to make new highs. And for the downside, if you go down here, tag that one, right? Bing. Back up here, close it out. Back down. Oh, the bulls think they're out of here, and that's not the case. More continuation to the downside. So you want to watch these two key levels right here. First one is 690.15, and the second one is 656.42. Intraday, this white line right here, we'll watch this on an intraday basis, but on a higher frame, you want to be paying attention to this number above 690.15. Say it again in 656.42. Now we're going to go to a 4-hour basis here. We're not going to pay any attention to this. I'm going to scan right out of there. It doesn't really matter to intraday trading or anything. And here are your key levels on an intraday basis. Put this one right here. This one right here. Well, we'll move these over just a little bit. Or we can move them over here, I guess. Oh. That one over right there. We're going to get a little bit closer. We're going to draw this gap in right here. Or maybe not. We will in a minute. So you see these sellers up here? What these sellers are telling you here is we do not want you going up and trading this at all. This is where a 4-hour support is. Think about the 4-hour candle. Starts around 1:30 in the afternoon. Here's a 4-hour. Here's your gap. Gapo. Go down to a smaller time frame. This is a 1-hour time frame. You remember what I said to you earlier about this being a day where we can't unwind as people expect? If we were not in Vixperation or QuapX, I would say to you right away, I would say to you, the trade here is this. Show it to you right here. And then I'm going to show you what I think happens today. I'm going to give you a Contra trade. There we go. This is Wednesday. This is 2 p.m. right here. $2 p.m. breakdown below this. There's Wednesday, 1600. Move this over a little bit. $12 right there. Nope, a little bit over there. This is end of the day right here. But I think we break this, or I think that's the intent, is that we break this right here. We'll save this to see if we can break this. What we want to be paying attention to, here is this. So you've got Vixperation day down, right? I gotta raise this one up a little bit. Hold on. This is wrong. That's up there. That's up there. This should hold. That's 2 p.m. Kind of wonky in here. That should go to 669 or 670 right up there. And then right around 2:30, you figure he's going to tell you no cut, no cut. Right? No cut, no cut. Squeeze up. Then you get the presser. Presser should sell down into the close over here. And we won't know until the close today. We won't know until the close today if we make this new low or not. If we make that new low, I'd look to see if we can bury this thing down here and unlock that 656 and then ricochet on Friday. Right in here for QuapX. If we cannot, we come down here for QuapX, or for today for Fed Day. Then we park right around here into the rest of the week, into Friday, and then we make our way higher, and then we'll blast down and take care of all of this stuff. Not on the 20th, but on start rolling down into the first or the first, second, third, fourth. I think we have like 3 days left into the first week of the new month in April. We will then unclench to get down there and hit that thing. I don't think we can do this, but if we do this, if we do break down through here and have a bloody night, we'll sweep right back up and get sucked up for Thursday and Friday and just park right over here. So we don't really know what this is going to be at this moment. Just look at it as a target down here into the end of the day of 662. Now, a Contra trade. We're going to chat about that. And the Contra, now this is what I would expect. Bloodbath down here. But because of what's going on alongside all of this stuff, Vixperation, QuapX, and that sort of stuff, I really expect us to do just this. Ready? This is the drop. And we just literally grind in here. Just going to grind. Maybe we go down here into Thursday and Friday. And then we unclench to the upside over here and we start climbing. And that unlock doesn't happen. Maybe we get this unlock right here, but still back up. And up and fade, or run to the upside. So we'll watch this closely, but as a Contra trade, if you're thinking that we're going to go down here today, I doubt it. I doubt it. If it was any other time, I would say, fuck yes. Or if we do, it's going to be fast. Like down here, slam down, and then sucked right back up into QuapX. But I don't think it happens. I think they save this. I wouldn't pay you if I was a dealer. I would suck you in here. and then I wouldn't pay you until after or near not just OpEx but month end, and pay that shit after the end of the month, end of the quarter, where the unwind can actually take place. So just be careful. The one thing I want to say to you today, if there's any top line thing to say to you out there today, is you're going to have this like extreme bearishness here, and you'll be like, oh my God, it's going to crash. We're going down. And more than likely, it's going to be a sideways thing. You're going to see like sideways all day long today, range bound. You're going to get sucked into quarterly OpEx on Friday, and then you're going to get some unwinding to the upside. So just be really careful with like downside, like doom. If today was like April 1st, I would say, fuck yeah, we're going down there. We're going to fucking take all those lows out. But for where we are with expiries and where the market is like drilling into this this quarterly OpEx and this quarter end, I would be very wary of that trade. If you any trade, I think we talked about it yesterday. You should get doom on Vixperation, and then thereafter it's nothing. We don't do anything. It's just they're going to take all your options. So think about the idea that a quarter's worth of options are going to die across all the markets, and they're not going to pay you. That is what they're going to do. They're going to suck the life out of your positioning. If you're looking for major positioning, you likely want to wait until the first week of the new quarter, when this unwinding is done taking place and all these options are dead, and we decide where we're going to go. So this is what I would normally expect. I don't expect that today. It's not in my plan for expectations. We're going to go over to a 1 minute, and we're going to set this up for you. And we're also going to talk about gamma here in just a minute. So let's look at this right here. This is, let me just put some timelines in here. Here's 12 p.m. We'll move this one over here. Sorry, this stuff doesn't scale when I start doing this stuff in higher frames. This is 12 p.m., a little bit of unwinding, right, into the 2 p.m. over here. Let's look at this right here. This is, there's 2. Sorry about that. So grind, right? A little bit of, oh God, we're going to break out up here. And instead down here, right? We come in, this is 12 o'clock. A little bit of unwinding as well up here. Oh my God, no rate cut. Everything looks great. We're going to escape. Slam you back down again. And potentially some more doom into the close over here. We'll draw this in over here. This is 1600. Right in there. Everything's been done. The gap's been filled. And then what happens is you come into Thursday and you're going, oh my God, we're going to blast down here, all this kind of stuff down here. I don't see it. I see it like Thursday float up, right? And just park down in this zone. You're trapped in here for QuapX on Friday. And then once we get that unwind on Friday, you should see a big squeeze to the upside. And they'll try to fade this move higher. They're going to try to fade this move right up in here. So here's your Friday. I don't know where it is over here, but pretend that's Friday. So you got your quarterly OpEx 663, I think it is, or something like that. But then that unwind into the 21st, 2nd, 3rd, 4th, 5th. This is where they're going to try to stop you from trading this 675. They're going to try to pin you down into this 672, and then maybe we start fading into the beginning of the month. Now, there is something else here that I want to show you. If the unwind goes against you into the beginning of the month, we can trade as high as 690, believe it or not. So you got to be careful of this Vanna. Be careful of a Vanna trade, and then also trying to get a nice high Murder the VIX again. Put your hedges on at the pristine moment, and then the bloodbath after the month. So you got to be careful. This could get roped in, like pinned in here, trying to stop the bulls. But there is still that potential to go to squeeze even higher. Vanna and Charm trade all the way up to 690. So that's still available here. And there's a couple other mechanics here you want to be paying attention to. If we break this one right here, not this one. If we break this one here today, like just the tip, that's it. That actually opens the door up here. If we fail to break that tip and they suck us up here, I would expect to quick slam down and lock, and then maybe something like that into the beginning of the new quarter. So be paying very close attention to these inflection points and when they do get tagged or not tagged. Excuse me. Sorry, my voice is trash right now. Let's bring you over to the main screen. Yeah, shoot. Hold on a second here, guys. Come on now. You can see down here, there's going to be buyers down below. If you look above on Bookmap up here. And buying it all back for the quarter to resell again. Let's take a peek down here. Put this one up right in here for you. Right about there. This right here for you. Yeah, I still think we can squeeze up. Maybe not there. Hold on a second here. This is 12 o'clock. Is this 2 p.m.? Yeah, right up there. It's 2:30. You already got the idea on this right here. Where's that other? Right in there. There's the gap. Just want to show the pivots really quick. Just so you can see where the pivots are. There's a pivot here at S3 at 664.16 and S4 661.17. And S4 S5 is there's a 3-month right there, and S4 S5 right down here at 658.61. This is a 1 sigma move. This is a 2 sigma move. Want to look at that? And just a note for you today, if you're on YouTube, you can chat if you're a subscriber, not a member. So all you have to do is click subscribe, and you can start chatting. You have to do anything to chat on YouTube today. And due to FOMC. I'm going to post for you prior FOMC rate decision. Past FOMC market reactions. The sentiment was on the January, the last rate decision, the Fed said that economic activity continues to expand at a solid pace. Inflation remains somewhat elevated, and the unemployment rate has showed signs of stabilizing. The FOMC voted 10-2 to keep the benchmark rate unchanged at 3.5 to 3.75%, with Governors Waller and Miran dissenting in favor of a 25 basis point cut. What you want to be looking at today, can't see that down there. Yeah, you can. You're good. Right down there. We're good. Today, the big thing you want to be paying attention to is, do we have more dissenters? And I'll read some stuff to you in a little bit if you're paying attention to today. If we get like 3 dissenters, it would be very rare for that to happen, and even more rare if it's an appointee, or if it's one of the Fed governors that becomes that 3rd dissenter on whether we should cut rates or not. I'm going to take a look really quick at the 6 and 3 month. I'm assuming that we're not getting a rate cut by the 3 and 6 month. Yesterday's 3 and 6 month auctions were yesterday, the day before. There was no sign of a rate cut today.
Department of National Intelligence's Gabbard says Iran could develop a viable intercontinental ballistic missile by 2035 if it chose to.
U.S. interest rate futures push back the chance of forward-looking Fed rate cuts further following hot PPI and geopolitical escalation. Goldman Sachs saying for today's FOMC meeting, the market is pricing in a 35 to 45 basis point spot jump for most USD pairs, consistent with the historical trend, and seems fair given elevated uncertainty will likely be used to caveat most opinions and projection updates. As per GSFX Research's preview for all meetings this week, in line with consensus, GS economists expect a hold today, but with 3 dissents in favor of a 25 basis cut. Governor Bowman now joining Governors Moran and Waller in line with Nick Timmeros's preview. The statement is likely to indicate that the war has increased uncertainty about the outlook and will likely raise inflation and weigh on economic activity in the near term. Further out, we expect 2 additional rate cuts now in September and December, with both moderate further labor market softening as well as progress on underlying inflation contributing to the case for a cut. We see the risks to this view skewed to the downside, with our probability-weighted Fed forecast remaining more dovish than our baseline in market pricing. I will post this inside the Discord for you here in just a moment.
The Bank of Canada press conference with Governor Macklem again has started. The live video is on the feed for those interested.
This is the piece from Nick Timmeros. Powell's second-to-last meeting previews an increasingly divided Fed. As many as 3 governors are candidates to dissent at this week's meeting, an unusual break that offers a glimpse of the fracture Kevin Warsh stands to inherit. Uncertainty fueled by the war in Iran. It's not really PPI. Well, I guess PPI would really get fucked up as time passes. We've already discussed that already this past week as these days continue. These days continue to pass, turn into weeks and weeks with the Strait of Hormuz closed. The Federal Reserve officials to sit tight at their meeting this week. That will make any dissenting votes all more notable as Fed Chair Powell nears close to his tenure as Fed Chair. Divisions at the Fed have been building. What until recently had been a culture of near unanimous votes has given way to more dissent, particularly from the governors President Trump has placed on the board. Over the past year, his 3 appointees have broken from the majority, including 2 at the Fed's last meeting. This week, all 3 are candidates to dissent in favor of a cut. Even if they don't, that such a split has become plausible meeting after meeting marks a shift that threatens to outlast any single vote. The significance isn't the vote margin, it's that all 3 are appointees of a president who is publicly demanding lower rates. 3 governors haven't dissented at the policy meeting since 1988. Dissents from governors land differently than those from the Fed's other policymakers, and the reason is structural. The Fed sets interest rates through a 12-member committee that draws from 2 different pools. There's 7 governors who are appointed by the president and work at the Fed's Washington headquarters, and there's a rotating cast of 5 of the system's 12 regional bank presidents. Those presidents aren't political employees. They're chosen by local boards of business and nonprofit leaders.
Bank of Canada's Governor Macklem says the Iran war impact on the Canadian economy depends on the duration. So again, he's doing his press conference now, and the video's on the feed.
All 19 participate in the policy discussion, but only 12 vote. Dissents from the bank presidents occur from time to time, but until recently, governor dissents carried more weight because they were so rare. Stephen Moran has dissented in favor of easier policy at every meeting since joining the board last September. I would point you towards the opus that he wrote. Basically, Moran wants to tear down the association on the short and long end and what the Fed does. The top line is he basically wants the Fed to be working on sentiment, then let Treasury deal with long term, with a longer end of the rates and the longer term of the rates, and try to like break the system that we have in place right now. February's unexpected drop in payrolls reinforced his argument that a weak labor market is near a tipping point. I disagree with Timmeros and Moran, I was talking about Moran above, but this is Waller. Christopher Waller also dissented at the most recent gathering in January and is seen as a candidate to dissent again after Feb's unexpected drop in payrolls, which reinforced his argument that a weak labor market is near a tipping point. I completely disagree with that. Not completely, but I don't think it matters until next or end of the year or next year. None of the payroll or unemployment data actually agrees with that statement. Outside of the zeitgeist and the twisting and turning of all of this data to fit a narrative, Michelle Bowman cited the labor market report as evidence that the economy could use some support from our policy rate in a television interview 2 weeks ago.
We will see some shifts in the composition of growth.
In December, she penciled in 3 cuts for 2026, more than most of her colleagues. Trump last year named Bowman as the Fed's vice chair for bank supervision. This is kind of fascinating here because you've got cuts next year and you've got to fight for cuts right now. And the reason for the cuts right now is because there won't be an opportunity to cut the longer that we get into this year and inflation starts to rear its ugly head and we start to run the economy hot. So they want these cuts right now because they know that they can't do them as time passes. This is why we've been fighting, or why certain members have been fighting for these cuts so early. Trump has repeated, and this is what's ironic about this is that if you look back on 2008, if we do not get those cuts, this would be the first time in history where we go back into a system that is more expected pre-2008, where we just leave rates, we don't actually cut to zero. Once inflation starts to rear its ugly head, you miss that cocaine-fueled rallies from these cuts, and we go back into a more normal system. So this is like the crux of the argument is post-2008, here's the nipple, start sucking on that free money or that money printer, and the Fed, as we went through COVID, you saw all of this data whipsaw up or down, and then you saw it all whipsaw back into line. And you have the Fed at that time period, in this whipsaw, like let's say you had inflation whipping. Inflation whipping like this, right? And then you've got the Fed tightening to bring inflation back down into some kind of like I should draw this differently. You have like normal inflation up and down cycles, and not since like 2008 have we seen this like whip all the way up here. This was COVID. We'll use this as an example because some of this data goes up and down. As we came back down into this data pool, there was an argument. Hey, don't start to arrest the market here, but we did. We did to stop this whipsaw from growing like this. So, so when we come back down into this normal inflation here, we're arresting it, and we're at the bottom of this inflation cycle. And you know, the crackheads out there for low rates are like, no, we want to party a little bit more down here, just a little bit more party and a little more rate cuts because we know we're going to go back into a tightening cycle for the rest of this, or not the rest of this year, but the end of this year into the beginning of next year. So they want the cocaine like right now. Like, give me the cocaine. Give me the cocaine because inflation is going to start running hot, and we know when inflation goes up too. There is a run it hot type mentality in here, and it doesn't really. We don't really start tightening until later on.
Time to assess the implications of the Iran war.
We have not been used to like a good economy with rates higher than zero since 2008. That was the norm for us to have a good strong economy and maybe not rates at zero. This is like a complete like cycle that's been going on since 2008. And so you've got three presidential appointees that want rates cut, or they want more rate cuts for a period of time here because they know that at some point you can no longer cut rates, and that window gets smaller and smaller and smaller. And of course, Powell has outlasted all of this until May. So you would expect that as the moment that Powell was gone, it's going to be like rate cut, and try to feed and fuel this like inflation, run it hot environment as long as we possibly can. Get the cocaine rolling. It's so bad to say that stuff. Even as a bull myself, I would like to see more normalization of rates, but I don't like the idea of cutting to zero. But you know what it is. So Trump has repeatedly bashed Powell, whom he named Chair 8 years ago, for not cutting rates more aggressively, and demanded last week that the central bank lower rates immediately ahead of its scheduled meeting. The standard advice for a central bank facing an oil shock is to look past it, concluding that the hit to growth and the boost to inflation roughly cancels each other out. But that advice assumes that the price bump will be short-lived and that people still believe the Fed will get inflation back to normal. This is a whole other discussion on like inflation cycles. They're like, it's like we're just reading that right there, that you can just look at a normal inflation cycle and we're at the bottom. We're in normalcy right now. Some former Fed officials questioned whether the economic case supports a rate cut this week. The Fed's preferred inflation measure was already running above 3% before the war in Iran sent oil prices sharply higher, adding a new source of price pressure on top of tariffs that may not have fully passed through. And some of this stuff kind of also like, some of this stuff is timing for the midterms, of course, right? You just need the economy to hang on, give it a little bit of cocaine just until the elections are finished, and then we don't care if it crashes, right? Fuck it, we did it. Now inflation's rampant. Go in there and do a tightening cycle. We remain in power. Fuck, who the fuck do we care? We got 2 years left. We run everything. So there's a little bit of that in there as well. Like cut, inflation ramping, prices. It's like this wealth effect, fake wealth effect, where you're like feeding inflation going higher. When you're feeding inflation going higher, of course, the stock market is worth less. If you don't understand this concept, the S&P 500 should ramp with inflation at the beginning, and you're not really wealthier, but you feel like you're wealthier. And that serves, of course, the midterms, right? Everything is great, man. Gas is up, but dude, I'm making money. Wages are increasing. I'm making money in the stock market. Everything is great. Vote Trump. Bam, done.
The Eastern Province residents in Saudi Arabia get an alert of incoming attacks.
And then, of course, you get the hangover, right? You get the hangover afterwards, and everything is bad, and inflation's now out of control. Tightening cycle comes into play. The bears come and raid the market in, early mid 2027, and the party's over, right? And then we leave the mess for the 2 years from 2027 and 2028 for the next whoever's in power. Who the fuck cares, right? Doesn't matter if it's MAGA, Republicans, Democrats, terrorist Antifa. It doesn't really matter, does it? If the party's over, the toga party's over, we've done everything we needed to do, and we leave the mess to be cleaned up for whoever assumes it later down the road. So continuing on here, the Fed's preferred inflation measure was already running above 3%. Preferred inflation measure, not actual inflation. Before the war in Iran sent prices sharply higher, adding a new source of price pressure on top of tariffs that may not have fully passed through. Unironically, too, tariffs have been struck down, and the new blanket tariffs are only for 150 days. Quote, to dissent when your base measure of inflation is above 3% and has been trending in the wrong direction would signal that you're okay with inflation, said Jim Bullard, who dissented several times as president of the St. Louis Fed and is now dean of the business school at Purdue University. Quote, I think it's a tough case to make. And I think before I even read the rest of this to you, I think you have to think about not recent memory, but there's a big divide between like pre-2008, post-2008. And do we stay on this same track, or do we revert back to this pre-2008 normalcy? Like, what is normal? When the Fed cut rates in December, I hate reading this stuff because I know some of this data in the background, and it's like just reading this stuff, I'm like, oh God, this is so cringe. When the Fed cuts rates in December, 3 officials dissented, but in the opposite directions. 2 bank presidents opposed cutting rates, while Moran favored a larger reduction. Bowman broke the seal on governor dissents in 2024, becoming the first to oppose a policy decision in 19 years when she voted for a smaller rate cut than her colleagues. Last summer, she and Waller dissented. You see the picture here? We're going to use rate cuts to help with sentiment and party time and all that other kind of stuff, and no longer use it as to try to blunt normal cycles as an actual tool. Several former policymakers applauded the development.
If we begin to see core measures go up, that's a sign inflation is spreading. Seeing German 10-year yield up 5 basis points to about 2.95%.
Several policymakers applauded the development towards more open disagreement, basically in party time or not party time. They don't want to say that, though. At an institution that encourages consensus. But some have worried about a difference between governors occasionally breaking ranks on the merits in a pattern where all of one's president's appointees vote as a block, meeting after meeting in the direction of the president's urging. Before we continue here, there have been moments where I do not like Jerome Powell, and there are moments when I've really liked Jerome Powell. And from what I can see over the years, I mean, even with this, I don't like him, now I like him, now I don't like him, it did seem like the Fed and these bank presidents were attempting, or maybe forced into attempting during COVID, to try to normalize and use these tools that they have to try to get back to some kind of normalcy because of the outside of the range moves we were getting. It's like, man, we can't do this, right? We got to work on this, and then we got to leave this in some kind of normalcy pre-2008 at this point, right? And of course, there are a lot of other people that don't want to do that, right? There are presidents that don't want to do that. No, I don't, you can't blame Trump either. To some extent, even if it's not a public thing, like Trump is very bombastic, he's very public. All these presidents want, or all these the executive branch wants that control. You can't say that you're not going to hear if the Trump and the executive branch is able to take over power from the Fed. It's not like you're going to see a Democrat come in and say, "Oh yeah, we cede this back to the Fed." You're not going to see it. You will not see it. Like the bad guy, but like dad's mean, mom's nice to you, or dad's nice to you and mom's mean to you. It's like good guy, bad guy. Power. Everybody wants power. In the executive, in the legislative, in the Fed, even in the judiciary, right? So, and meanwhile, you and I are out there. We're just looking. We just want some normal out there, and or my position. I want it to print. So I want that cut just from my position. But in reality, this is more of an argument. Do you want to party? Do you want to keep partying? Do you want to keep seeing this, craziness here and craziness here, or do you want more normalcy pre-2008 or not? Quote, it's hard to ascribe the motives to individuals, but if the market interprets that they're reacting in a political way, I think that it's a very dangerous grounds, end quote, said Boston Fed President Eric Rosenberg, who was one of the 3 dissenters at the 2016 meeting. In countries where central banks have been undermined by political pressure, he said, the public eventually lost confidence that officials would take unpopular steps to keep inflation in check. That loss of confidence itself made inflation harder to control. A related risk is that what begins as healthy dissent gives way to the type of partisan divide that has shaped the Supreme Court, where individuals reason that they're following
shocks differ from COVID because of economic slack.
That they're following their own analysis, but the public only sees party alignment. That would be a notable shift at the Fed.
We don't think we're going to see a rapid pass-through of higher energy prices.
Voice news disconnected.
Where the trade-offs between stable prices and a healthy job market haven't historically broken down along party lines. For some central banks, such as the Bank of England, evenly distributed votes on policy decisions are routine. The Fed has avoided that, not because officials always agreed, but because a broad consensus meant markets and the public could focus on the economic outlook rather than trying to predict which faction could or would prevail from one meeting to the other. Waller himself has acknowledged the risks that finally split votes sow confusion. Quote, if it gets really down to 7-5 votes, then one person switches at the next meeting and the whole trajectory changes, he said last year. Dissents sometimes amount to a challenge to the Fed's leadership. That's less likely here. With Powell's term ending in May and Kevin Warsh, Trump's chosen successor, awaiting Senate confirmation. This is more like a structural change, isn't it? In the dangers of that structural change. Instead, both sides of the committee could use Powell's waning tenure to draw lines ahead of the transition, underscoring the consensus-building challenge Warsh would inherit. Hawkish officials, for example, could use this week's quarterly projections to signal how they would resist rate cuts with an inflation rate stuck well above the Fed's 2% target, which we actually hit. We hit that target. We did that. Even Powell admitted that. But of course, that narrative still persists. Quote, there's going to be more concern about influencing how a new chair may be thinking about the dynamics of the committee, said Rosengrain. Any dissents could also remind the regional bank presidents that the political dynamics around monetary policy have fundamentally changed, said Vincent Reinhart, a former senior Fed advisor who is now chief economist at BNY Investments. Quote, they should have approached that there is this force and it will grow over time, end quote. If Trump gets more seats to fill at the Fed, said Reinhart, quote, it should be a reminder that your Fed forecast from here on is more about the political economy than the macro economy. And, they didn't say that, they kind of said here, it's not going to matter who's in power. You should expect that to persist, even if Trump were to lose power. If you look closely at whatever these changes, this like smear shit on the wall and attempt to break things and see what breaks and see what doesn't, I would ask you, if you don't like Trump, you should keep track of all of the things that actually do break And then the next time your party is in power, I would go back and look and see which one of those things that were broken was actually rescinded once that party is out of power. And I'm almost going to guarantee you that near none of it will be ceded back. And that's why we have a separation of powers, right? So that doesn't happen. But of course it is happening. Hold on a second here. Just want to watch this with you. We're close right here. Came down, bounced off the four hour. We're going to see if we can get one more rejection above here and maybe kind of plant ourselves down in here. We could also start rising at some point and like riding higher into 2 p.m. This is a typical price action on FOMC. Let's watch this closely here. Watch this 5-minute check back right now. See if this holds. We'll watch this closer here so you can see it. There is a bull plane forming here, but I wouldn't trust this trade for an upside trade until you can get above it. And you can see that cross take place over here. So what you can trade that, of course, but be careful as you trade this up and down movement here. You could get trapped and sent even lower. Most of you know the rules already, so I don't have to say anything to you. Let's watch that closely right there. So that was Nick Timmeros, the Fed Whisperer, aka the Fed Whisperer. I'm going to give you one more outlook here, or not outlook, but one more take on today's FOMC at 2 p.m. Quote: This is from the BBG. Quote: Hormuz Hold'em. FOMC preview: the Fed's playbook is hold or cut, not hike. Hold or cut, not hike. The FOMC is expected to leave rates unchanged at 3.5 to 3.75%. Let me just check this really quick. Let me just make sure that there's nothing in the background here. Just make sure there's nothing in the background with the 3 and 6 month that I'm missing. Maybe something sneaking up in the background. Anything leaking in the background here? Yeah, 3 month is still stuck here at 3.699. And also the 6 month yield is cranking right now, showing no cuts. FOMC is expected to leave rates unchanged at 3.5 to 3.75% in March. Money markets do not expect a rate cut before Q4 of 2026. Although pricing may have been influenced by a rise in short-term yields following the recent energy price surge linked to the Iran war, markets now fully price in one rate cut this year compared with around 2 before the conflict. As News Squawk notes, while some Fed officials have suggested they can look through one-off spikes, inflation is already well above the Fed's 2% target, which analysts say could constrain the committee. The inflation upside comes amid renewed labor market pressures, even before the conflict. February jobs report showed a minus 92K change in non-farm payrolls, likely raising questions about the stagflation of at the post-meeting conference. That's horse shit. I'll tell you right now, that's fucking complete horse shit. All of these losses are either from illegal immigrants working and being removed from the U.S., or they are assigned to Fed, not the Fed, but federal workforce reduction. The Federal Reserve is not tasked with saving those jobs in any way, shape, or form. Remember, it's private payrolls, not government payrolls, even though they're included in some of our unemployment and employment numbers. So it's not a perfect system. I know you're like, oh my God. But in fact, that's where those job losses are. The committee remains split between, so the private unemployment employment situation is great. The only negative thing about our private payrolls is that no one is moving jobs. People are staying in their jobs rather than jumping from job to job. Wages are in line, but not cranking higher at this point. So there's no like, hey, I want to jump over here and get more money, get an extra $10 an hour, an extra $20 an hour, anything like that. Then layoffs are in line right now. They are rising, but they're in line with historical examples. They should continue to rise with inflation, but this is something that's more like 6 months, 9 months, a year down the road, where they really do start to matter. The committee remains split between prioritizing the labor market and inflation sides of the mandate. Governor Waller has been vocal about labor market concerns, especially with AI now adversely impacting the job market at scale, which may guide his decision, while others remain focused on above-target inflation. Economists surveyed by Reuters expect the FOMC to cut rates in June after Fed Chair Powell's term ends in May. Despite the disruption from the Middle Eastern conflict, which has pushed up energy, metals, and food crop prices. So I want you to think about that. I want you to think about the idea that when Powell is out, you already got inflation, historical inflation. Let me see if I can show you a chart here. Hold on here. Oh, it's not. I don't know if it's on this. It may not be on this computer. I can't show you this chart right now at this moment, but if you look at historical inflation over decades, we are at a bottom of inflation. So if you add this fuel to this fire of natural inflation, historically natural inflation, you add on the war and then you add on more cuts, it could get spicy. Not negative, like vertical, like the market going vertical, excuse me, straight into the midterms. It is so funny. After Fed Chair Powell terms end in May, despite disruption from the Middle East conflict, which has pushed up energy, metals, and food crop prices, separately, Senator Tom Tillis said the nomination of incoming Fed Chair Warsh may remain before the Senate Banking Committee for some time due to his objections to advancing Fed nominees before the DOJ probe related to Powell concludes. Hold on a second here, guys. I gotta get some water. Whew. Watch this. There's a bull plane forming right here. Just keep an eye on it. Morgan Stanley, which expects the Fed to stay on hold in March as it debates the outlook, including the degree to which employment has stabilized, the risk higher oil prices pose to inflation and activity in the appropriate path for monetary policy, expects the dot plot to continue to call for one rate cut this year and next, despite upward revisions to headline inflation from the recent rise in oil prices. This would be consistent with past practice of looking through an oil-induced increases in headline inflation. This is why you should be looking for either no cut today or a cut. You either get the dissenters voting for a cut, we get a cut, or you get no cut today. And you should be expecting a cut once Jerome Powell is out the door. The only thorn or fly in that ointment would be the Senate stopping that nomination due to their investigations. Heading into the meeting, MS retains its outlook for 225 basis point rate cuts this year in June and September. The main risk to the bank's outlook is that the median member pushes out rate normalization on account of inflation concerns. However, that is unlikely, quote, since it would run counter to past practice in dealing with oil price shocks and the softness in February employment. As such, the risk to monetary policy is asymmetric. Rising oil prices amid above target inflation is more likely to make the Fed delay cuts or cut more when it does. Then it will move to rate hikes. I.e., if you don't get a cut today and you're looking for that June cut when Powell leaves, you could see not 25 basis points, but maybe 50 or a full fucking 1.00. The votes. The January meeting saw two dissenters, Moran and Waller, both voting for 25 basis point rate cuts. Commentary from Fed's Bowman has recently been very dovish, raising the risk that she joins those favoring a cut. Waller said he would vote for a cut if January job strength faded in February, which it did. Moran is calling for 425 BPS rate cuts this year, sooner than later. Elsewhere, this is so much politics mixed into this argument right here in this paper here. They're like pushing aside facts here for political leanings. Elsewhere, the board in 2026 voted members leaned neutral or hawkish, aside from Paulson, who also appeared more concerned about the labor market, whose vote may be one to watch. No one is calling for rate hikes, but Hawks suggests policy is at or near neutral. I agree. I'm 100% on that boat. 100% on that boat. And those aren't Hawks. Those are just normal people. Goldman expects 3 dissents in favor of a 25 basis point cut because the latest labor market data will push Governor Bowman to join Governors Moran and Waller, who has also dissented in January. Morgan Stanley also looks for 3 dissents in favor of a 25 basis point cut. Remember that if you get that dissent, that should be hawkish in price action. The bank expects Bowman to join Waller in favoring the 25 basis point cut. On March 6th, Bowman said she believed that the labor market could use more monetary policy support and still support 75 basis points in rate cuts this year. The FOMC statement. According to GS, the FOMC statement is likely to acknowledge that the war has increased uncertainty about the outlook and is likely to raise inflation and weigh on economic activity in the near term. The statement will also likely describe active activity growth as moderate rather than solid. And in the light of the latest employment news, the committee will likely modestly downgrade its description of the labor market. I disagree on that point, too. I think is going to discuss, or maybe discuss, that this was the federal employees and immigration policy that impacted the unemployment numbers. He will, though, likely, in my view, say something about the stagnation of job growth. That's an issue. That is a real issue, the slowing of job growth. And another issue is no one is jumping from job to job. So the perception here is that the labor market is in disarray, but in fact, that's not really an indicator of doom ahead, even though there likely is going to be doom due to this inflation thing down the road and the coming 6 months to a year down the road. What else do we have here from these guys? The SEP is the SEP or the SEP is likely to show adverse changes to the 2026 forecasts, including higher core and headline inflation, lower GDP growth, and a higher unemployment rate, which is 0.2 pp to 4.6 in Q4. 4.6 is healthy. Say it again. 4.6 is healthy. These changes to the economic projections would have roughly offsetting implications for the Fed funds rate. Uncertainty around the SEPs is high, as forecasting during wartime is difficult, and much of the economic impact depends on the duration of the conflict. I agree with that. President Trump has suggested it will end soon or within a couple of weeks, though that is hard to verify. We have another setup for a down move. Not this stuff, not this floating around stuff, but we have a big setup for another downstroke in mid-April if this war does not end in this Trump executive setup that the war will be over in 2 to 3 weeks. You'd be looking for a low around mid-April, early mid-April. Given two-way risks, some policymakers may push back rate cut expectations due to higher inflation risks linked to war, while others may bring forward cuts after the weak NFP print. What else we got here? Guide. The Fed is not expected to resume cuts under Powell's leadership, while cuts under Warsh are expected to accelerate. On the economy, the weak February report renewed concerns about labor market conditions, paths to further rate cuts. Goldman recently pushed the 2 additional rate cuts and its forecast back to September and December. Excuse me for 1 second here, guys. Just got to check this really quick. All right, hold on here. I just got to check. I'm getting some alerts here in the background. The paths to further rate cuts are back to September and December. The risks over the next year has tilted to the downside of its 3.3 to 3.2% terminal rate forecast. The FOMC could choose a slightly lower rate, terminal rate if inflation falls to or below 2% next year. It could deliver another package of insurance cuts if a new risk arises, and it would likely cut substantially if a recession occurred. Secession. Fed Chair Powell's term as chair expires in May, making the March meeting his penultimate one in this role. He may remain on the Board of Governors until his governor term expires in 2028. He is likely to face questions on his plans during the press conference. That's today. Though he typically declines to comment, former Fed Governor Warsh has been nominated to replace him, but Senate confirmation is delayed as lawmakers await the conclusion of the DOJ investigation into the Fed and Powell. If confirmed, Warsh is expected to replace the dovish Moran on the Board of Governors. If Powell leaves the Fed entirely, it would create an additional vacancy on the board. A new direction under a new chair. With Jay Powell's term as chair ending in May, investors have begun to ask whether the Fed will take a new direction under Trump's nominee, Warsh, on interest rate policy. Warsh has been dovish in part because he has been confident that inflation is headed lower. While these views would position him, that's not true either. I'm going to stop talking about this part here. I don't even want to read this shit because this is not true. He has a white paper. Do yourself a solid and go out and read what Warsh has to say on this not inflation, but short-term rate policy, and how he wants to disassociate long-term rates and short-term rates. Because this is all political stuff I'm reading right here. I just can't do it. I can't push the narrative that's bullshit. Rates. Brian Bingham, short-term interest rate trading. The inflationary VAR shock priced into Europe, the euro and GBP front end spilled over into USD. Whites in full force last week with straights cheapening greater than 50 BPS. You don't need to know any of this stuff here. If oil stabilizes above $100 a barrel and CapEx deployment buffers any corresponding growth shock, unlikely, though certainly not impossible. But the burden of proof needed for Warsh to hike straight out of the gate, now priced at close to 10% probability, would require a deterioration that is difficult to fathom, much less proactively bet on. Well, you can bet on it if we go low enough. You'll get a rate cut if the market goes down and trades anywhere around 620 to 6,000 and looking lower to 5,600. Yeah, you'll get some rate cuts really fast, one way or another. Mitchell Cornell from Volex Trading saying the market has experienced a lot of gyration leading into this FOMC with direction central bank expectations taking a back seat to geopolitics and forward-looking at inflation expectations. This bout of volatility in macro markets started 3 weeks ago with AI productivity figures for the labor market and turned quickly to the prospect of a quick pickup of inflation with the rise in energy prices from the conflict in Iran. Our franchises continue to be better buyers of receivers in 1 year and 2 year, 1 year type forwards and to back up in yields. However, payers have richened materially on basically all forwards as the market quickly turned to a yields higher and vol higher basis. We are looking for the FOMC to either provide the market with some calm about the prospects for easing or perhaps exhibit caution about the forward path of inflation. Either way it'll be good for the market to hear from central bankers this week after the blackout period amid stress conditions. What else do we have here? The Fed is likely priced in hawkish inflationary policy shift in Iran. given the potential downside risk to risk assets if the market does price a negative growth shock from here, we think it makes sense to use periods of relaxation to hedge deeper downside scenarios. Heading into Powell's FOMC, penultimate FOMC, the focus of equity vol traders has been mainly focused on geopolitics and the war in Iran. The interesting pass-through effect is whether the recent spike in energy prices leads to a more cautious, hawkish dot plot out of the FOMC on Wednesday. Vols remains elevated in the front end, and one-day XPX straddle for FOMC looks like it will go out roughly 85 BPS. One interesting wrinkle is that VIX expiry is the morning before FOMC, and we think this could free up SPX spot to move somewhat. As the pressure of imminently delivering one-month variance is removed from the market, we think long topside makes more sense than long downside options given elevated risk levels of skew, and like owning NDX options more than SPX options with the spread very low in the front end of the curve. While Powell's commentary becomes less relevant as he approaches the end of his term as chair, we do think a hawkish dot plot could potentially spook markets lower when combined with an uncertainty out of Iran. And I'm kind of with this trader here. This is Vicky Chang from Macro Research. I think you can get like that downside shock today, but I think it's limited. I think the real danger is that we don't go down enough like we haven't these last two lows, and then we begin to have a vol watershed moment to the upside, and then we get pinned into QuapX, and then we have some more unwinding to the upside into the beginning of the month. As long as the market can stay underneath that 70 or that 90, the market can then roll to the downside in the beginning of April. What else we got here? Credit. We're not going to talk about that because credit's bullshit. Not bullshit, but it's bullshit in terms of the or its relevance to the price action in SPX. What else do we have? I think that's it. I think that's all that I've got. That's it. That's all I've got. I think that's everything. So I think you pretty much have the expectations for today. I would expect any of this downside move on 2 p.m. You basically want to be watching all of this to hold. The only downside inflection point that would need to be tagged is this new low right here. If there was going to be any kind of doom into 2 p.m., some kind of this is 12, but like 2 p.m. Tag this one right here, and then I think we start heading higher. Maybe 15% chance we can get down here to this 656. But even if we do get down there, it should whipsaw straight back up. So you are looking to buy dips down below here. Any kind of dip you can get down here at 661, 656, or even once this gap or this last known wicked smart money buyers are down here. If you can find any of this and any kind of downside action on volatility for that vol watershed and that pin for QuapX, and then the rest of the Vanna and Charm and all the other bullshit that's going to take place into month end, to get a good positioning for more down to come in April if the war were to persist. And I think we reviewed most of that yesterday on the stream. I think we reviewed most of that on the stream for that other leg down. And then if you were going to buy volatility on these highs, that you'd be winding up in the same place in mid-April to unfuck that trade if the war wraps itself up in terms of volatility. If you don't know what I'm talking about, we can talk about it right now if you want. We can rehash it again. Let's take a look right here. Let's go to, let me see if I can do it like this. Now this works right here. I think this works right here. The easiest way to crayon this for you, top line this for you. This is SPX right here. This is this prior high right in here. So if you're buying volatility on highs, this is middle of April right here. you have a couple opportunities to do it. You have an opportunity up here, and I want you to pay attention to this zone right here. This is April. Well, I'll try to make this make this more realistic right here. That in all scenarios on highs, right in here, if you look closely. So the sell side here is looking for this bloodbath. They're looking for that bloodbath right there. They didn't get it. They were looking for this bloodbath right here. They didn't get it. This is the bear case, right? The bear story. And it becomes more and more convoluted as time passes, right? You're like, whoa, hold on here. This is how the bear story or case goes. We've got war in Strait of Hormuz. Can we get the bloodbath? Price in an extended war. Can we price in that the U.S. has failed, or they're not failing right now, but that they were failing on controlling the narrative, right? How long is it going to last? This looks dangerous, all that kind of stuff. They kind of improve that picture here, right? They didn't get it here. And then you've got FOMC meeting. Can they get the drop here? Right? So you're trying to hedge highs here, here, and here. Or I should say that Trump and the executive has done a great job over the past weekend and the past few days in controlling that narrative, right, to get their message out. So you've got, as time passes for the bear thesis for this shank to go down here, right, they squeeze your balls off again up here. This is your next opportunity, right? You start fading down over here, and then all of a sudden you're squeezing up here. And if, let's say, the 2 weeks pass, 2 or 3 weeks, and Trump comes back and says, it's devolving, it's worse. As a matter of fact, this one right here should be where U.S. troops. This one right here should be where U.S. troops should be boots on the ground and trying to escort ships, setting up all these arrays of knocking things out of the sky. So here's the bear's next case. And then you've got the bear case up here. Bear case up here to go down. This is the roll for the 30th. So you get the contract roll up here, right? You got hedging, whether that's here or here, doesn't matter. Doesn't matter if we get reined in right here. You have another opportunity right here. You know, that bear case, though, gets a little long in the tooth, right? And over here where you have more opportunity for, hey, can we get that bloodletting to the downside? Get that bloodletting to the downside. The story changes, becomes a little bit more positive. So here's where the setups are for, at any rate, here's where the setups are. And even if you, let's say you get the down move here, the chasing of rolling of hedges in the beginning of the month, you're still like in this zone right here. You know, do you get what I'm saying? So there's no real risk to, hedging with volatility on highs, even if there's a resolution to this war that's going on. There's time in here, 2-3 weeks. And, you know, the longer that we wait, the more the crying takes place, right? Didn't happen here, didn't happen here. Does it happen here? Probably not. Is it going to happen here when you wake up over the week, either this weekend or next weekend, you get the U.S. troops, you get the news on a weekend, oh my God, the U.S. troops are doing it. We're going to wake up Monday morning with a bloodbath down here, and we don't. They come over on Sunday and tell you everything is fine. We're actually opening the Strait of Hormuz right now. But we're still dealing with like drones and this and that, but just not nearly as many. Market starts going up into the end of the month. And then all of a sudden something bad happens. Oh, we've had a 1 step back to the 2 steps forward, right? It's one more chance to the downside. And hey, you said 2-3 weeks. No 2-3 weeks. And all of a sudden Trump tells you, hey, we did great job. And that's your last chance. So this bear narrative, we're at where we are right now. What are you going to expect here? You're going to expect the bears that want this print or sell side. This isn't the print that they want. They want this print. This up here is weekly trigger, daily trigger. It's already like, this isn't what you need, right? You need this. And not only that, you need to open the door that I showed you earlier this morning. You need the door down here, whoop, so that if you don't go down there, that push up at least opens the door to do this or to do this down here. And we haven't even opened that door yet, have we? That door has not been opened. So at a bare minimum, when when you got a seller telling you we got to go a little bit lower, bro, we got to clear out that 6,600. In fact, what they really want to do at minimum is open that door, even if they're not going to blast down there, to give the case to go down. And there's something else here too. If you don't watch the show every day, you already know that we're on risk off. And if you're a bear, you should already know that the door is right here to close. This door to close, we're getting closer and closer and closer. You're like a fan of McGilligod or whatever. You know, you only have so many chances. You only have so many chances to close this door. You know, you cannot have prices bouncing up in here, you know, and then all of a sudden it's a higher low in here. And then it's like popping up here, right? And this goes away. And before you know it, we're backing this up. And we're up, up, up. And out of here to the right-hand side over here. So you should hear the cacophony of bears that say, hey, here's our window. Here's our window. No matter what squeezing happens, we need to trap these guys in, and get that downside move either into the end of the month or into the beginning of April, whatever it may be. Even if this drop is only, you know, whether it's today, right? Sellers love that, but if they can't get it and they finally do this down here, whoop, they finally open that 3 month that I showed you. No matter what squeezing takes place into the beginning of the month for liquidity, even if it's up here, the door is open. And then you can start shanking this thing down pretty badly to the downside. This is worst case scenario for sellers. There's not necessarily go that high. We could just like come up here, float around, and then you get the plunge to the downside in April. Go back over here. Just watch this closely here. Remember the 12 p.m. flows. It's now 11:32. Get a little bit more weakness down here and just look to see if these flows can pick us up. Buyers stepping in at 12 o'clock. Also note that buyers stepped in at 10 a.m. as well. I'm going to show you two things here. We have multiple markets. We've got Asia, London, and U.S. I want to show you here. This is 10 a.m. They sent this down at 10 a.m. right here. You should expect new flows as we come into this 12 p.m. And you should expect London to leave and in the New York market to try to buy this up into the actual FOMC at 2 p.m. So 2 p.m. is right here. Make this a 4. Make this yellow or red. We could do red, I guess. Red would help. This is the Fed here, and then the Fed over. Can you guys see that? Yeah, you guys can see that. There's the Fed right there. She thinks we moon. I think if we moon in here, it's all going to come back. We should be parked right in here towards Friday. Let me just check, make sure I got that right. I just want to make sure I got that right. I want to check, make sure nothing's changed here. We're going to take a look at one other thing next. We're going to look at gamma for the day. We're going to do a live snapshot of real-time one-date gamma. We'll look at two-date gamma thereafter. Just wait till this. I gotta give you a few seconds here. We gotta calculate these numbers really quick. And we're gonna take a look at. We're gonna go to SPX gamma. All right, first thing we're gonna do. Wait a minute here. Let's check. Oh, I didn't mean to do that, but that'll work. We're going to look at gamma exposure on the market. We're going to first look at one date right here. This is on tradethetrigger.com. Max pain today, 6760. We have room to trade. Bottom of the market, 6630. Put wall at 6675. 6690. And then we have a small like we have gamma. Let me see if I can get this right here. Gamma flip is sitting at 6745. There's a small number just underneath it here at 6730. And then we have 6900 to the upside up here for the call wall above. One quick second here. Can you guys see this or no? I just want to make sure you guys can see this. Six 66820. Right here. Currently trading, and this is just one dates. Currently trading right where my mark is right here. We're at 6683 right now. No, we're a little bit higher than this. Hold on here. Go back. Right here. So I'm becoming an old man right here. So currently, price is sitting parked right here. And if you're looking for a vol shock to the downside, this is the bottom of the option market right here. This is 6630. This down here is 6500. So 6630. We want to pay close attention to that. Okay, go back over here. Hang tight 1 second. Six 6675. 6630. So make sure you guys can see all of this. Hey, Roy, poot wall. Let's check this right here. This is your gamma picture for 1 dates. These can change frequently. But if you're looking for a range on today, move this over a little. This is Monday, it's Friday right over here. This is a gamma gap. So you have buyers coming in, right? Or buy, right? Some volatility on Powell. Worst case scenario down here, and then whipsaw up. 6,760 above. That's the pin. Into the close today. There is also some call stuff above 6,745. There's all like calls monetization in here. That's pretty much what you're looking for, though, right in here, 1 date. Remember down below here, do we hold this gap? Or do we smash through it and then make our way back higher above? We'll switch back to the regular screen here. We've got this right here for you. So this gamma, the gamma for today for 1 dates mirror the same thought. Right, you're cranking up here, right, into 2 p.m. Worst case scenario, we're down here. This is where that gap is down below. This is a 1 minute chart, so don't be like, oh my God, that's all that doom. This would be that downside move, and then some kind of whipsaw above, some kind of a, either it's down like this, and then a whipsaw higher. This should be worst case scenario down here. Worst case scenario. Here's another thought process too. If we're not waiting for 2 p.m., slam it down. That then erases all of this, and the market would be able to go higher into that 6,760 6760, you should see some monetizing up there. 6740, 6750, there's a bunch of call monetizing up there. Watch these flows that come in at 12 p.m. See if they're buy or sell flows. Give me just a few minutes as 12 p.m. comes online here. I'm going to take a quick break, and I'll be right back with you. The news squawker is on. We'll see if we can meet that downside intraday expectation down here. If you want to go back and look at the one-date gamma chart. And before I take this quick break, I'm going to talk to you about, bring that up right there. Before I take this quick break, I'm also going to quickly give you some expectations as of today without price action to impact two-date gamma. I'm just going to quickly read off to you if you want to write this down at home. For two-date, we have the bottom of the market at bottom of the market shifts on two-date gamma to 6,600. The put wall for tomorrow is 6,650, and we have a pin or a pin of 6,775. And guess where max pain is for tomorrow? Max pain for tomorrow. Listen as closely here. 6,900. On SPX, 6,900. So if we get a vol watershed today, and remember that this is a 1-minute chart right here, right? I want you to remember this is a 1-minute chart. This is not an hourly chart right here, so we're fairly close to this low, right? This is much closer than you think. The bias here is to the upside, so we might not get this. We could get this right now. You could come into 2 p.m. and have a quick downstroke, like woof, down here, and then violence straight back up. Right? Start violently going back up, pinned in here, and then into Thursday, Friday, or into tomorrow at least. There's a pin tomorrow to trade 6,900. 6,900 as of today's gamma. That's where we are. So just be aware. SPX gamma, or not SPX, actually SPX at the money volatility. As soon as that, as long as we're not like blooding down and getting shanked here today, right? That there is a huge bias into tomorrow to the upside. The targets for two-date tomorrow, if nothing goes wrong, 6,775 and 6,900. So if you're a bear, there's a trap down here for you. To get really bearish where we are right now, you kind of need to be like down here, and then you need a second low over here to put on a new trade. Remember, this is a 1-minute chart, so we're really close. You kind of need like that hammer down, then turn this into resistance. For all of that two-date gamma to change tomorrow. And that's where the real trade is, like right in here. Remember that this is a 1-minute chart. We're really close to that bottom. So just a heads up to you out there. And I know that there are traders here that want to see, just that unlock down here. And for that gamma picture to change. But just be aware, okay? Just don't say I didn't warn you. Don't say I didn't warn you that there's a massive squeeze hiding here in the background. I'm going to take a quick break here, and I'll be right back with you guys. I got to just, like, my throat is killing me. I got to get some water in me. Stop drinking coffee and start rehydrating. How you doing there, Jack? What are you doing? Were you happy with me feeding you raw meat this morning? Come here, good boy. What are you doing there, old man? You have a good run in the park today? You like the park, don't you? And then fed when you get back in your old age. Morning run, crawl back in the house, and then get fed meat. All right, I'll be right back with you guys. Give me a few minutes here. Watch out for these 12 p.m. flows. We have a series of higher lows right now. Low, higher low, trying to turn up. And I'll be right back.
Italy's Deputy PM Salvini says Italy may cut excise taxes on fuels as soon as Wednesday. So US's DNI Gabbard, cites reporting that China, India, and other countries have been able to move tankers through the Strait of Hormuz, says the volume or measure of those moves was not available.
Keep note that the hour and half an hour trigger are crossing the weekly trigger right now.
US VP Vance is to meet the American Petroleum Institute board members on Thursday. So that's Vance to meet with oil executives as fuel prices surge.
Just bear with me here. I'm going to set up the Fed presser on this screen here. So just for a minute, you might see some screens popping up in the background, in the front here.
US VP Vance on gas prices says, I will announce a couple of things in the next 24 to 48 hours. Katz reports that Israel struck 2 bridges at Lebanon's Litani River. So 2 loud booms have been heard in Riyadh, according to witnesses. Riyadh does have extensive energy infrastructure, serving as a central hub for Saudi Arabia's power generation and electricity grid. So US's Gabbard refuses to answer a lawmaker on whether there was an imminent nuclear threat posed by Iran. Russia's Deputy PM Novak to TASS says we are currently witnessing the worst energy crisis in the last 40 years. Russia's Deputy PM Novak to TASS News says the Middle East conflict is currently affecting at least 20 million barrels of oil per day. Saudi confirming now that their air defences are dealing with a ballistic threat in Riyadh. State news agency reports that Iraq's SOMO signs a contract with international carriers and buyers to export oil via Turkey, Jordan, and Syria. Russia's deputy PM Novak to TASS News says 20% of global gas production is currently unable to reach the market. from the IAEA, following information from Iran of a projectile incident on Tuesday. They can confirm that a structure 350 meters from the Bushehr NPP reactor was hit. Saudi Arabia now saying the danger has passed in Riyadh city. No confirmation whether any energy infrastructure has been hit.
All right, here we go. Getting there now. So take a look here. I'm kind of following this path pretty well right now, right? The bigger question here is, do we whipsaw? Do we get, there's a whole bunch of questions here, of course, right? Do we just escape and we're out of here?
Voice disconnected.
Oh, hold on a second here. What's going on? Check this right here. Still not seeing the presser here in the background. Give me a second here, guys. Oh. All right. So apologize. Got to get all set up here. I was trying to get some water down my throat to cool off my throat. Let me get this screener back up here. Okay, biggest question here, of course, is can we even knee jerk to the downside? I'm sure you're all pretty well versed here at this point. Some key points here I'm going to give you some top line price action stuff here. Now, the last non-event, let's start at the top here. Today's FOMC day. It's also Vixperation day. We get a contract roll. There's initial doom this morning on that contract roll for Vixperation that took place this morning. And the last non-event, FOMC, we went down. We had initial rip higher and then going down. This one is a little bit different. We have today we've got Vixperation, the quarterly Vixperation. We have quarterly OPEX on Friday. We've been going down in the markets here, and you know that at minimum, the bears. Remember, that's just a term for a heel. It's not really true. There's no such thing as a bear. If you're a bear, it's just a heel term. You should buy or sell or whatever, you know. But for inflection points, I would think that the bears want to at least hit 661.17. In a perfect world for sellers, they want to hit 656.42 on some kind of negativity or hawkish tone from the Fed on a non-event day. A trader earlier I had read to you the trader saying that she expects the market to squeeze up. And that there is a potential to go down. If we end up going down here, we could drag sideways and not unclench, and the unclench comes after QuapX. Now she does say that the risk is not to the downside, that the risk is to the upside at squeeze. Now the bigger question becomes: do you get a cut today or not, or is it just hanging on, or no change? Is there a chance for a breakout up here, or do we get reined in on a non-event, or do you get some hawkish tone and we end up going down from the Fed? Do they ask the questions like, do they pry into Jerome to the downside? So the first thing I want to say to you, is remember OPEX on Friday. Any move that's made down or up is likely gets reined back in for OPEX. So whether it's down, right, if you're like, hey, you're bearish here, if we go down deep, it's likely going to come back and magnet that close on Friday. That close on Friday, let me just check net really quick. So net right now is 6,600 on SPX. 3 dates for Friday currently is at 6,700. This is 3 dates, but that 3-date gamma can change. So the net gamma is 6,600. The 3-date gamma is for a pin on 6,700 or 6,900. That's the range for Friday without having any separate price action as of today. Closing price that can change that kind of stuff on short-term gamma. When the quarterly OPEX too, there's another thing here with quarterly OPEX, which is here, let me just show you this. So maybe I can just show it to you. Let me just check this really quick. So like max pain is 68.15 on Friday. The low, if there was, then as a matter of fact, the 3-date 6700 magnet is smaller than the max pain at 68.15, and it's smaller than 6900 to the upside for Friday as of right now. For magnets and stuff like that, but you've got just remember that 6600 is underneath the prior low. So that's down here, somewhere down in this vicinity, down in here, for Friday. And then the upside one is really high. And then we also have to deal with the month end stuff on this stuff. So just, I think the greater point here is this: heading into this event, I don't like trading binary events personally. Not a fan of them. But if you're going to try to make a break or bank on this kind of stuff, as we get wrangled into Friday, I want you to know that it could be short-lived, your trade. The potential for us to get sucked into this QuapX on Friday where we're trading sideways. Like Friday, we'll talk about Friday some more after this, but if your shit is like really on a really deep low and is heavily shorted, you could see some real big movement against your position on your individual stocks and stuff. That goes against your positioning, so just be wary of that. The S&P 500 tends to trade sideways. Sometimes it moves, but not often. It'll tend to drive sideways. But if you're in like a overly shorted spec growth or meme basket or something like that, if your meme has gone to the moon this whole entire quarter, you should expect that to blast down on quarterly OPEX. If your stock's been shorted to the depths of hell, there's that going on. Also, this something else that's happening in this quarterly OPEX that's unusual is if we go too high, let's say we trade like 670 or something, you're going to get option sellers trying to dump on the market on Thursday. If we go too high for sold calls, but then you could also have on Thursday, this is before Friday's QuapX, you could also have small hedge funds, boiler rooms attempt to buy SPY to capture the dividend. So even if we like rip up to the upside and we're not reined in or whatever, and let's say you see some continuation on that, so what you would do is you get option sellers trying to get SPY lower or pinned in here, and not to go too much lower and not to go too much higher, right? But then you got people trying to buy the S&P 500 to capture the dividend between Thursday and Friday, and you could wind up seeing like a rip and then dump just on the open, just like today, on the open of Friday to pin us back in. So there's a lot of mechanic. My point here is there's a lot of mechanics at play. There's a lot of like mechanics pulling back and forth, and what they can do is what they can do for you or against you as a trader is for the rest of the month or the quarter or whatever, you're making a plan, right? Like I'm going to do this, I'm going to do that, and you execute your trades, and then you go to close your trades. And then when you come in, if you're beginning a new trade, like right now or tomorrow or Friday, and you're like, hey, I'm going to open a trade right now, it's probably not the best thing to be doing. Everything gets thrown out the window. You'll be like, why did this happen? And the stock's going the completely opposite direction for any news, good or bad, doesn't matter. And that's because the mechanics are moving in the background. You've got dealers trying to clean everything up. You've got trades that have been open for a full quarter trying to close those things out. You know, when I draw those when I draw that circle chart, and I say, hey, these are the participants in the stock market. This is 25% of the market. This is 15. This is 30. This is 30. You have a lot of different players all in that circle all at the same time, and people get run over. If there's 3/4 to 60%, 70% on this one trade, and you're that one guy going, I think we're going to go here and we're going to go there, and this should work. It may not work because so many participants are in the pool. When there's less participants in the pool, you can usually, do your thing and will the market to go where you want it to go. So that's not a sign that you're a bad trader or your system doesn't work or whatever your tools or your rules are, whatever you do out there, whatever you follow, gamma, Elliott wave, ICT, triggers, it doesn't matter. Anything, you pick it. Traditional charting, you just throw that shit out the window. There are easier days to trade and easier days to open positions. So just be aware of that as we head into this volatility at 2 p.m. And further into like Thursday and Friday. A lot of you shouldn't even, if I say to you, don't trade today, Friday is a really hard day to trade on QuapX. And as a note on that, in the Discord, I'm going to post for you the most shorted stocks in the market before Friday so that you can potentially take one of those trades instead, a counter trade on Friday morning or even Thursday close into Friday morning. Now today, if you're going to take a trade on these FOMC days, there's a couple rules here. If you are going to say, fuck you, Cap, I'm going to make a bunch of money up or down here. There's a couple rules that I usually abide by if I'm going to trade zero dates, and I'm going to list those off to you right now. 1, dealers will attempt. So normally when you're hitting, let's say we're going down. As an example, let's say we're going down, right? Or up. It doesn't really matter. This works both ways, but you've got these targets down below, right? Oftentimes, it'll be like because option interest will wane after the event. You'll see like a down move and then ricochet straight off up here, then a down move, and a ricochet off up here. What they're doing is they're repricing the option chain. So let's say you've got some calls or puts or something like that. All that interest will go away, and you might be directionally right, but you're not making any money in your trade. So you got to be like in out, and in out for profit. If you're on the wrong side of the trade, let's say your puts are getting annihilated, they could print. So if you're in a losing side of that trade, you hold them until they do print. And if you're going to you can put stops, like let's say you're long calls, you put upside stops and you take the money and run. You don't just like, I could have made $10. You're just like, I bought them for 10 cents or I bought them for $1. They went to $2 or 10 cents went to 20 cents or whatever. 20 cents went to $1. It doesn't matter. You take the money and you bounce and walk out. Another rule here would be let's say this market runs away to the upside. This market runs away and it leaves you behind on an FOMC. Oopsie, you couldn't chase. Or maybe it runs up here, bounces back down, starts getting higher, and you want to chase. That's fine. But in truth, on these FOMC days, you're always looking for like an opportunity to get long from a low. Or you're looking for an opportunity for the bulls, let's say the bulls, they run away with it on the upside, right, of the buyers, right, whipsaw up here, whipsaw back down, and then there's an unclench to the upside. You could take the opposite side up here. So if you're not already in a trade heading into this, you could be just on the edges. On the edges works really well normally. Now, and sometimes you just get left behind too. So my point here is like stay on the edges if you're not already in a trade. If you get left behind, it's okay. If it's going to rip to the moon, you're likely kind of an easy short in there. If it goes down in the depths of hell, there's usually a really nice long in there. And you're not going to get annihilated right in the middle. See where we are? Right in the middle right now. So a couple other notes on this FOMC in particular is there's a cluster here. There's an hourly trigger crossing the weekly trigger and a half-hour trigger. This can serve as a big, like, fuck you, no, we're going downtown. And if you see prices break above it like this could actually begin a squeeze. So there's a squeeze zone above. but if we can't get above, there's a big rejection zone to the downside. Just be aware of that as well. The setup here is for volatility. Even if this is supposed to be we're not going to cut, we're not going to change the rates or anything today. Just note that this is very rare. I rarely see this on an FOMC, either above or below. Just be aware of it, okay? So sit on the edges. If you get left behind in a trade, so sit on the edges. If you get left behind in the trade, you can always take the opposite. Sit on the edges. If you get left behind in a trade, don't kick yourself on that. If you're in a trade and it's going against you, you want to hold it longer. If you're in a trade and it's going for you, take your money and run. Just walk away. Hey, I made 300% today on a binary event. I'm out of here. You buy something and they look like they're a penny. Like maybe bought some for 10 cents, goes to 1 penny. Just hold them. Don't bother selling them, because that might go from like 10 cents to 1 cent, then to $1. And that's both sides, up and down. So just be aware of that as we move forward today. There is some positivity here today. It's probably Jerome's like last hurrah. Maybe the market sends it higher for him, or people assign that to it. You got a nice little squeeze here today. If you want to know what my thoughts are here, like what my personal opinion here that takes place, you can already see it. I already have it up here, right? We come down here to this 4 hour, right? Start like fading up into here. You get the, hey, no cut, or no hike, or something like that, or a cut. We go up here and potentially start running. But if it's just like no hike, no cut, or anything like that, an initial blow off here, and then we could potentially get a whipsaw down right here. And then maybe some negativity on some of the questions to Jerome, and then you're buying a dip to go higher. So even this right here, I'm going to change this to a dotted line. I wanted to draw this in here, but it's just kind of wonky. Like, okay, we're going to go there and then up and then down and then up and then down and then up and then down. The best trades are after today, just as a heads up. But heading into this quarterly OPEX, I don't know that they could pin us in here. So I'm going to delete this for right now. I'm going to delete this for right now. And what I really want you to do is I want you to just live on the edges here on these inflection points. As we head into this, FOMC decision right here, I'm going to get rid of this one too. The one you really need to know are these two red lines right here. The first one is for the initial press release on what the determination of the Fed is, and the dissenters and the SEPs and all that other stuff. And then at 2:30, you're going to get the press conference with Jerome Powell taking questions from people in the from journalists in the audience. I'm going to get rid of these like support lines right here. They're not going to matter, or not that they're not going to matter, but they're kind of lined up with where we are. We got to clean out some stuff down here. It's a little bit messy in here, so we're going to get rid of the pivots. We kind of know where we are. And I'll have the press conference live. The two things you're going to see here. One, the news squawker is in real time. It's not delayed. So you'll have the news squawker explaining things to you. I will post in the Discord the full press release from the Fed. And then at 2:30, I will have a video up on the screen with Jerome Powell's press conference at 2:30. Be patient as we head into this area over here, or into this 2 p.m. time frame, and try to ride the edges if you can. I get maybe you want a better, like, what do I think is going to happen today? If you do, I would like to buy a dip off of the new low right here. This is where I'd like to buy a dip, and I'd like to see some kind of an escape to the upside. Some kind of a rip faces off higher here. This over here. Let me just check a 30-minute here in the background. Let me just check some velo on SPX and just see what velo looks like here. See if I can see anything. Like the daily velocity looks great. Hourly velocity looks good for bulls. Let me just check the daily velocity and that weekly trigger above there. That weekly is almost at neutral. It's turning up, believe it or not. The daily velocity looks like shit. Yeah, not really like shit. It's okay. It's put in a lower low as of today. If I had to err on the side of anyone today, it's probably for the bulls to get the rip higher. So if we can get into the new low or the last known smart money down here, close the gap. We're already here. So if we can take out this stuff down here and catch a nice upside move. Another thing too is another thing to talk to you about here is if we're going to make our way higher after OpEx, right? And they're going to reprice options, the bigger trade for more time on your trades would be to wait until after the event and the repricing of options with a spread or something and put enough time on it to capture it in a week or two. I'd date it for like the first week of April or something like that for a high. And even if you get more, let's say you do a spread at the end of the day and they shank you down a little bit, but then it recovers, magnets into QuapX and then starts heading higher, you're not going to take as much pain down here. Don't freak out on spreads down here if your bias is long. If they like shank it down, your spreads will come back to life in like a week or two or something, or a week or something like that. Not even a week, 3 days, 2 sessions, Friday. For the most of you out there, you shouldn't be trading this, and you probably shouldn't be trading on Friday. It's a time for you to sit back, let the market digest everything, and remember something. I want you to remember something here. I was telling you about not opening positions because so many people are in the pool right now closing positions. Those people that are closing positions today, Friday, they're looking to reopen positions on the 31st. And they're looking to open positions that's March 31st. They're also going to be looking to open positions the first week of April because you should see some movement that first week of April too, and then you should see a low or a high, and then you can take it again. So just note that you're running against the currently, you're running against the current of, if you're like, hey, I'm opening a position here, and 90% of the market is closing positions. They're closing position, except for VIX. People are closing positions on VIX. I showed this yesterday. I could show you again, but the VIX high that was put in, and then over the weekend, so the VIX high was put in last Friday. And there was a hope for a big bloodbath over the weekend. Some bad shit happens, or the White House doesn't take control of information. And when that didn't happen on Sunday and Monday morning, they started selling the VIX, like closing their VIX longs or volatility longs. And then they're looking for a low to get in on today or Friday or the end of the month. So that same process is going to take place for equities on this Friday and on the end of the month. So just be a conscience of that while people are trying to close positions and then reopen positions, and you're trying to open positions as they're closing, and instead of staying with the market. It's always easier to stay with the market when you're like, well, I want to be a contra trader. On these things, you don't want to be a contra trader. You want to be with the market because so many people are in the pool. So here's the last chance here coming into 2 p.m. for the bears to knock out these lows. They'll have another opportunity on Friday, and they'll have another opportunity end of month, on the 31st of March. We'll watch this closely as we park in here. A second here. So I've got the player up from the I do have the player up here. I'm not seeing the YouTube link, but I do see the Federal Reserves. If you want to watch it at home, I do see the link already up on the Federal Reserve site, but I do not see the link available yet on the YouTube channel that they have. Normally it's up at this point. Fuck is going on here? Hold on here. Yep, SPY has an upcoming dividend. We already talked about that. Let me just check around for the news here, guys. You ready? I'll draw this in for you. Ready? You guys ready? You guys are like, there's no fucking way that's gonna happen. 677 right there. Mm. Take that gap right there. Where's 1600? Something like this. It's so stupid drawing this stuff in, but then up here 678 and then back down. I'm exaggerating this a little bit. It should be something like this. Wham, 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 and then something like this. But I'm going to push it over a little bit just so you can watch it. Follow the dotted line. Also, do not take the lines that I draw as what, or that this is where I think it's going, but do not take that as an enticement to take this trade. You're responsible for your own trading. Probably draw that in better. It's not so insane looking. And then I'm looking for the dip buy right down here into this close right here. Let me move that over right there to the 2 o'clock. Careful of the whipsaw. These whipsaw moves can be larger than what I'm drawing. Like I'm drawing this, but they could whipsaw down right there, whipsaw up, whipsaw all the way down there. I kid you not, like that. Even like that, believe it or not. But just note that we can whipsaw the whole way. Deals are try to add some supply at every play at every You know where all that stuff is. You don't need me to tell you. It's gonna sit right here. Make this nice and fat and big. This plunge here could this plunge down here could take place right now. We could also go into this moment, quick whipsaw down and then up. That's what this dotted line is. Even though it's in behind time, it's hard to like draw all this shit in here. So it looks kind of like it'll look like one line going straight up and down. So I just want to get the idea of what should happen down here. If you want to know the upside target, it's 678. 678 upside target. It's a big move. What is that move right there? Pretty big move right there, right? What is that? Tip the tail. 2% move. Half an hour until the decision. 1:28 right now. So we still got a little bit more time here. Mm-hmm. 678s are 3 cents right now. Woohoo! You don't want to take those though. You want to take a little bit in the money, a little bit more in the money. trying to get set up here to put a trade on. So nice little zones right down there to grab a dip.
Saudi Arabia says they intercepted 4 ballistic missiles launched towards.
I bet. I bet there, Mr. Bear. Our just a heads up here, our news squawker is extremely bearish at all times. Coming into the new half-hour flows. I'm going to turn a couple notes for you here before we get into this. I've turned the ads off on YouTube. So if you want to watch us on YouTube with no interruptions, you can. But YouTube has native delay. So if you want to real-time watch this, you have to hit the cog wheel and speed the stream up to get to real-time. But YouTube will still push it back after a few minutes.
Saudi Arabia says assessment indicates there is no damage.
Voice.
If you want to watch us on Twitch, that's real time. If you watch us on Twitch, the broadcast is real time. That real time broadcasting on Twitch has ads that I cannot turn off at all unless you're a subscriber. And you can actually subscribe for free through Amazon Prime. So if you want to watch in real time without having to hit the cogwheel, you go to Twitch, you sign up on Amazon, you'll have no ads. If you want to watch with a few second delay that YouTube enforces, you'll get no ads over there. So you guys understand what I'm saying here? The real-time broadcast is on Twitch. If you sign up as a member or if you subscribe or follow on Twitch via Amazon Prime, the ads go away for you. It's free, and you have an ad-free experience and real-time. It's the best way to view a live stream anywhere on Twitch. On YouTube, you can at key moments just hit the cogwheel, speed the stream up by like ×2 or ×3, and you'll get to a real time for a few moments. SPOO's recovering slightly here. SPY unwinding a little bit up to the 5-minute trigger. Consensus is the upside bias, though there are some sellers out there that want to see that downside print. Positionally, there are a lot of the market that's hedged wants to see that new low. The bias is to the upside. From what I can see in the option chain, the positioning is all puts. From what I can see. Let me just do something here in the background. Got a little bit of work to do here. Just check some news here in the background. Anything last minute we need to hear? There we go. I've got the presser up now. Just if you want to watch it at home, the presser is now on YouTube. If you're looking for, this morning I didn't have a chance to do the stock picks today, the update on stock picks. SNDK has been cranking. UMAC cranked. LB starting to crank. We picked them yesterday, I think. I'm going to give you a list right now if you want to write them down. For spec growth, stock picks. I know a bunch of you out there pay like $300 a week or a month for picks like this. I'm going to give you them for free right now. VG. I don't charge that, but we just do it for people. I'm going to list some off for if you want to write them down. VG, KRMN, UMAC, UMAC, CRCL. That one's breaking out right now. LB and SNDK. It's a normal segment that we do. Most days of the week here on the show. We are live Monday through Friday. Please hit the like and subscribe button. If you can post the links to these streams, I would appreciate it. I did turn the ads off today, so if you like and subscribe or follow or whatever you can do, if you can repost this stream, whatever you're watching it on, we're streaming today on Twitter, Twitch, and on YouTube. We're not streaming today on Kick, nor Truvo either today. Also notes that if you notice the background has changed, if you haven't been here in a bit, normally this is our biggest stream of the quarter. If you're noticing the stuff in the back here, we're just beginning a nighttime stock show. We're going to be doing like a review of the indexes, crypto currencies. What else are we going to be doing? Like the top traded stocks that all the retailers like. That we're running pilots right now, and there'll be a nighttime show for like I think a half an hour from 6 to 6:30 p.m. or 6:30 to 7 p.m. Monday through Thursday, I believe, or Sunday through Thursday or something like that for in the future. So just be aware of it. We built out a new studio back here. I've got a bunch of cool stuff. I got like those are like 80-inch TVs. They're huge. They're really far behind, but we have like tracking cameras and stuff. It's gonna be really cool. The lights come up, and I'll be standing back there, and I'll be rolling up my sleeves like Jim Cramer and stuff. So you'll get a market overview at nighttime, and you'll get we're gonna start. We track right now our stock picks, but we don't do it enough with enough follow up. So we're gonna start tracking a Trade the Trigger ETF and see how they perform, where the buy points are, and are we at those buy points? Are we left behind? That kind of stuff. Check us out on tradethetrigger.com. We also have a Discord community. You can always check us out, tradethetrigger.com. If you're looking for a trading group to join, you're more than welcome to join. If you don't like it, just be like, hey, I don't like this, and I'll refund you your money. You can try it out for a month. Just waiting now for the press release. We have 16 minutes left. At 2:30, you'll see me put the Fed chair up for the presser. Let me just check SPX at the money vol really quick. I'm sure it just spikes to this moment. Yeah, oh dude, the drop off here is massive. Volatility expected to drop over the next 18 days from this moment. 18 sessions. Now, of course, you can't track volatility that far out in time, but we're not primed for volatility after this moment right now. We're primed for a vol watershed. Just be aware of it to the upside, that after this moment at 2:30, vol is expected to fall off in a major way for days ahead. I should preface that saying, though, too, if that volatility is blowing off, you should see, like, CTAs should add supply at any of those major CTAs, COTs should add supply still to the market on those highs as that vol blow off comes. I'm going to move this over right here. You guys have already seen it. Just want to be able to see the price action. Hey, honey bear. How you doing, baby? How'd it go with that? My daughter just went and looked at a music school, private music school. Like junior high, that's the school is music. It's pretty cool. My youngest daughter is a couple things. Like my youngest daughter is performing now with like the Detroit Symphony Orchestra, and she's also, I think, trying out right now for the Detroit Youth Symphony Orchestra or something like that. And she's going to Carnegie Hall now. This summer she's performing in New York City. Can't wait. She's been doing outstanding. First chair, she's everything. She's such a badass. Just came in right now from an interview. She's going through like combine, like almost like athletes and stuff, going through combines. Oh yeah, she's going through like combines where like people rate her or whatever, and they write her name down, and they're tracking her through school to go to college. She's a baller. Hey, honey bear.
So just a reminder, about 15, 13 minutes time, we get the Fed interest rate decision forecast for no change. Just going to go through a little bit of commentary. Barclays, they say the FOMC is expected to keep the Fed funds rate unchanged, reflecting elevated uncertainty consistent with recent comments that policy is really in a good place. At least 2 dovish dissents are expected, with some risk of a third. The updated SEP will likely show higher inflation and to a lesser extent stronger GDP for 2026, while leaving the unemployment path unchanged. The median dots are still expected to show 125 basis point cut this year and one in next year, but no change.
You're gonna get 4 of those 25 BPS. We got to price that in, boys.
The Fed can afford to be patient. Geopolitical developments will likely be highlighted.
You get that third dissenter by May, it's a lock-in, basically.
A weak economic activity. But broader message should remain that policy is well positioned to manage risks on both sides of the dual mandate, and the decisions will continue to be made meeting by meeting.
Trump allows foreign ships between domestic ports to stabilize petrol costs amid Iran war. One in 5 minute trigger bull cluster or blue bull plane forming here. Doesn't mean we can't blast down quickly before we go higher.
At 2 p.m. Eastern Time, we have the US interest rate decision and FOMC rate statement and SEP. Forecast is for no change, prior 3.75%. Also expecting the Fed median rate forecast, with the current forecast 3.375%, prior 3.625%, with a range of 3.625% to 2.875%. Next year forecast 3.125%, prior 3.375%. Next 2 years forecast 3.125%, unchanged for the prior, and the long run forecast 3.125%, prior 3%. Looking at some more research, the Bank of America says the Fed is expected to keep policy rates unchanged at 3.5 to 3.75% at its March meeting, with an 8-2 vote, and Governors Myron and Waller dissenting in favor of 25 basis point cut. The statement is likely to include some reference to the Iran war, most likely by strengthening the uncertainty language around the economic outlook and possibly adding that a persistent rise in oil prices would put upwards pressure on inflation while weighing on economic activity.
Nine minutes left until we get a decision. I'm going to remove this red one right here so we can see the price action as it takes place.
According to sources, the Trump administration expected to soon lift summer gasoline regulations to curb energy prices.
You'll notice as we get closer to 2 p.m., this blue should go turn black at some point up here. God, every time we do shit like this, every time we do stuff like this, I'm like, yeah, we're going to see a big fat fucking red bar down to the depths of hell, or we're going to see a big green bar right off the screen, one or the other. They're always fun. Always exciting. Imagine if they gave a 25 BPS rate cut. Fuck. It's a small chance, but if they did that, oh man. Unexpected rate cut. Oh boy. This is my last FOMC. Fuck you. 50 BPS cut. Shing him out of here. I keep my glory. I got no cuts left to give, baby. Suck it, Warsh. Try to cut on your own time. That'd be fucking hilarious. Takes all the cuts away. Have fun, buddy. Start cutting for. Try to cut. It'd be hilarious. Just gives you a big fat 50 BPS cut. I'm out of here. Kicks over the lectern. Yellen comes out with some leather and whips and shit at the door, and she's like, come over here, honey. I've been waiting for you. Come sit down with us. Bears on the 2-yard line. Oh, man. The dove fed comes to the stanchion, whips out, unzips his pants, zip, pulls off the clip-on purple tie, clips on a green tie, gives it a spin. It's a fucking it's a fucking bow tie that's green. Gives it a spin and it starts spinning. 6 minutes left here. He's 7%.
The U.S. interest rate decision, and
we go 2% in like 30 seconds. I'll tell you that.
The Fed median rate forecast data. Current forecast free spot 3.
There's a dealer sitting in his office right now. He's got his finger on the sell button, and he's like, "Oh."
2.875%. Next year forecast free spot 125%. Prior free spot 375%. Next 2 years forecast free spot 125%, unchanged from the prior, and the long run forecast free spot.
I feel like I'm at the fucking casino right now. This is the biggest gambling fucking day. I kid you not. It's like pure gambling. Let it ride, baby, on red. It's fucking bear out there right now.
Looking at some research here, Deutsche Bank says the Fed is expected to keep rates steady, with policymakers emphasizing elevated uncertainty tied to the ongoing Middle East conflict and maintaining the view that policy is already well positioned. Powell is unlikely to give any strong signal or near-term moves, which would lead the Fed on course for a third straight hold at the April meeting. The statement may be adjusted to reflect softer recent labor market data by saying job gains have remained low on average and the unemployment rate has been stable, while also adding language that recent geopolitical developments are highly uncertain and likely to put upwards pressure on inflation while weighing on economic activity.
4 minutes left. Some other notes. I will be here with you tomorrow. Friday's stream may be self-guided. Might spend some time with the Discord on Friday hunting down stanks that should get the levers taken off them. These fucking days are like, every time we do one of these fucking things, it's like it's so like it takes so much preparation, and then the execution of it and the live stream, and it's like I feel every time we have one of these Fed decisions, I feel like today's Friday, not Thursday and Friday. Like today is Friday. Well, it's all culminating into this moment. Miran is in the back hallway. He's like, dude, just give me 25 BPS, bro. Just give me 25. Come on. Yellen's back there just whipping Jerome because he likes it. Likes that dominatrix in his life. It's like, should I give him one? Or should I give him two? 2 minutes left.
One minute remaining. US oil reserves gain trades near $96 a barrel. Excuse me, US oil versus gains trades near $96 a barrel.
Oil coming down to help the upside move on the decision. Never bet against America.
$10 seconds. No change. Rate remains unchanged at 3.75%. Fed median rate forecast data current 3.375%, 3.375% as expected. Next year 3.125%, 3.125% as expected. Next 2 years 3.125%, 3.125% as expected. Long run 3.125%, 3.125% as expected.
I'm reading the release right now for you. Hold on here.
Benchmark rate in 3.5 to 3.75% range in 11 to 1 vote. The Fed maintains predictions for 1 rate cut in 2026 and 1 in 2027. Fed says Governor Myron dissents in favor of a rate cut, and the Fed says implications of Middle East developments are uncertain. Seeing a little bit of downside in the dollar off the back of that rate data. So seeing here, Fed policymakers sees 4.4% unemployment rate at the end of 2026 versus
lower than predicted, not higher. They had 4.6.
2026 PCE inflation at 2.7% versus 2.4% in December, and core seen at 2.7% versus 2.5%. The Fed policymaker sees 4.4% unemployment rate at the end of 2026 versus 4.4% in December projections. And the Fed projections show 7 policymakers saw no rate cut in 2026 and 1 sees rates higher in 2027.
Just watch out here. The option. I'm watching the options market right now. Options market not pricing a squeeze into 678.
FOMC SEP on the feed for those interested. US stocks pair losses slightly after the Fed statement. S&P 500 last down about 0.6%, and the Nasdaq Composite down 0.5%. And we have posted the FOMC rate statement on the feed for those interested.
Posting it for you in the Discord right now.
Spot gold little changed after Fed decision, last down 2.2%, and US stocks pair losses slightly after Fed statement. S&P 500 last down 0.6%, the Nasdaq Composite down 0.5%. US Treasury yields pair increase after Fed statement. 10-year yield last at 1.2 basis points at 4.214%, and US Treasury 2-year yield last up 2.4 basis points at 3.695%.
Spoo's back testing the 1 and 5 minute trigger here.
Fed policymakers see 2.4% GDP growth in 2026 versus 2.3% in December, and see longer run growth at 2% versus 1.8% in December.
Not much movement here in VIX 9-day. Waiting to see if we can catch some more supply on VIX. VIX still holding, or VIX 9-day holding steady at the moment. I'm watching VIX 9-day closely here as it's still holding itself up here.
US interest rate futures see 21 basis points of easing in 2026, unchanged from before the Fed statement.
VIX 9-day still poised for volatility into this press, or maybe there's something we don't know.
Briefly versus the Japanese yen, last up 0.2%, and the euro pair losses against the dollar briefly after Fed decision, last down 0.16%, and the US dollar index pairs gains briefly after the Fed decision, last up 0.21%.
Whole lot of volatility holders here from this morning, hoping for more volatility into this presser. There's a little bit of selling of VIX 9-day. Not a ton, though. Also, the bloodbath here in regular VIX, 30-day VIX, it's recovering at the moment.
According to data, US rate futures expect Fed to resume rate cuts either in December or January 2027.
It's interesting here, like VIX and VIX 9-day is prepped for a rip, but I'm wondering what they see in this press conference here.
Iran president says infra attack will yield nothing for the US and Israel. So Iran president saying infrastructure attack will yield nothing for the US and Israel. US crude and gasoline futures reverse course and turn negative.
Taking a look right now, this whole move up here, not priced in at this 678, no escape. No reason to escape at this point. We get boxed in here all day long, just park right all day long. We might go nowhere. No down, no up. I'm reading through some of this stuff that's written here. There's no like gotcha. There's no gotcha in this press release. There's no like big negative, big positive. There is something fascinating here. U.S. rate futures expect Fed to resume rate cuts either in December or January. I disagree with that. I think your politics are going to get in there. They're always wrong with the Fed futures like gambling, but U.S. interest rate futures see 21 BPS of easing and 26 unchanged from the prior statement. I'm going to read some of this too as I read it. Oh, I'll start from the beginning. Hold on here. Trying to see if there's any gotchas inside of the statement here. Available indicators suggest the economic activity has been expanding at a solid pace. Job gains have remained low, but we're not losing jobs. But we know about this already. And the unemployment rate has been little changed in recent months. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The implications of developments in the Middle East for the U.S. economy are uncertain. The committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 3.5, 3.34. And considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. I think we said this yesterday. This would be the expected statement. Now, they're going to watch closely in case anything goes horribly wrong, and they'll adjust to those risks. The committee is strongly committed to supporting maximum employment, returning inflation to 2% objective, and assessing the appropriate stance of monetary policy. The committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. We expect all this. Voting for the monetary policy was. We already know who these people are. That's fine. Regarding monetary policy implementation, the Federal Reserve has made the following decisions to implement the monetary policy stance announced by the Open Market Committee. Board of Governors system voted unanimously to maintain the interest rate paid on reserve balances. As part of its policy decisions, FOMC to direct open market desk at the Federal Reserve until restricted otherwise to execute transactions, blah, 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 blah. Nothing else that I can see in there. So not a big shift here. Probably the highlights, if there were any. Fed median rates long run. Actual 3.12. 5, that's in line. Previous was 3%. Expectation, though, is 3.125. The median rate forecast is still in line. The median view of the Fed funds rate in the longer run is 3.1. The previous was 3%, but 3.1 was the expectation. I think they're wrong in their cuts. I think what they're doing with the expectation on cuts is they're trying to make the statement that they should keep politics out of the Fed. But I think that those days are gone. I think you're going to get the Fed politic or the executive politics as soon as he's out of there. So you can kind of see, like, when I'm reading through some of this stuff right now, and you can kind of see that the Fed is going to maintain that position, which they have to anyways. This is what we want to see happen, but of course you know that the reality is that that's not going to happen. There is a bright, shiny hope here. Fed policymakers see 4.4% unemployment rate at the end of 2026 compared to the 4.4% projections, but the projections are actually 4.6, not 4.4. There is an uptick, a negative uptick in PCE to 2.7 from 2.5 due to geopolitical risks. Same thing here with the GDP. Fed policymakers see.
Interior Ministry says civil defense dealing with fire in Ras Laffan area after the Iranian attack.
Fed policymakers see 2.4% GDP growth in 2026 compared to 2.3 in December. See longer growth run at 2.0 compared to 1.8 in December. They did make a statement that implications of Middle East developments are uncertain. Yeah, watch out. They've got the VIX going up right now. Just be careful out there. The VIX didn't blow off. Now it's squeezing right now. So we have volatility into this press conference. Just be careful here. I got a nice little cup right here going. Any upside surprise to 478 is out for the day. I think I said that earlier to you, but the options market is pricing in no move to 678 today. You might see it after today, but not today. You'll be reined in down here, reined into 669.22, unless something is said in the press conference. Also note here that VIX did not blow off below support at 23.20. It actually held down here, and it's actually rising right now. I don't know what their VIX is looking for in this press conference. Maybe there's something that's known that we don't know. It's rolling over again right now, but the VIX is holding into this press conference. Some kind of like gotcha moment or something like that. 13 minutes left until the presser. They could end up grinding here for the next 3 days, like literally today, tomorrow, and Friday into QuapX. Like just parked right in the middle for the next 3 sessions. No instigation to go higher. Nothing that I can read here that says, oh, yeah, this is good. Newswire picking up on uncertain impacts from Iran war. It wasn't that much of a highlight, but the wire is picking up on that. Watch out here, VIX climbing again. Watch out for a shank to the downside into this press conference. I want to start selling calls and puts here. I want to start selling spreads. For Friday. And a good trade here is likely to be selling calls and puts into Friday here. There's no real threat here that I can see for like anything lower than 660. And I don't think we escape 670. Tonight, if you want to sell some spreads here, it's a good idea for Friday.
At 2:30 p.m. Eastern Time, we're expecting the FOMC press conference with Fed Chair Powell. We have posted a live video of the press conference on the feed for those interested.
One second here, guys. I got to see my daughter really quick. I'm going to bring this press conference up for you right now. Just be careful here. The VIX is primed right now. VIX 9-day is primed to go higher. It does have a bear cross on a 1 and 5 minute underneath the 30 minute, but it is looking bullish right here at this moment. You could see a big jackknife to the downside. Just be careful here. Let me turn this. Okay, so we've got the JPOW thing right there. Could move this. Is that over there maybe better over here? And then maybe move this over so we can see the price action as we come into this. I'm getting all wonked out here trying to figure out what's going on. Getting all like, what's this and what's that? Six minutes left. Shot for a big gap down over here. Someone's pricing in volatility right now into this presser. Maybe there's something we don't know.
In 5 minutes' time, we're expecting the FOMC press conference with Fed Chair Powell. And a reminder, the video is on the feed for those interested.
Just a note that there's a video over there. As soon as the presser starts, we'll have it live for you. Just shank that volatility, man. Kill that fucking volatility. Fuck could he say in that press conference could be that fucking bearish? This looks benign to me. Like this statement looks pretty fucking benign. We've got a rate decision on, he's got one more rate decision on April 29th. What is that? Stop that. Sorry, I'm talking to myself here. So he's got at least one more meeting. So this isn't his final hurrah. So he's got one more meeting until May. Maybe they will beat him up today. Maybe there's a potential here they beat his ass up today. He still has one more rate decision. But it's not like he's going to take the victory lap like he's out of here. Maybe they don't take the gloves off on him today. Move this one over here. This is going to wind up turning into a non-event today. It's either going to be a non-event or it's going to be fucking bearish as fuck if they set his ass up. Or if maybe he makes something, a political statement of some kind. Something we don't know. I'm just going to remove this right here as he comes on board just so you can see it. So I get this in the...
Surely expecting the FOMC press conference.
VIX holding up. VIX 9 days still holding up. One minute left.
And the press conference has now started.
Hang tight here, guys. I got one feed that's delayed.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices
Fed's
for the
Powell
benefit
says the
of
economy is
American people.
expanding.
Voice news
The U.S. economy
disconnected.
has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are...
Just to note that they had two live broadcasts. One was...
remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little...
Be careful, VIX is trying to break out on the 9-day.
In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision.
He does not look good right now.
Policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations.
VIX 9-day trying to break out right now.
Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to
VIX looking for a reason to rip faces off right now. And I don't know what it is, something we don't know.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward, a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs. Going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't.
So I said that earlier to you. I said that shit earlier to you.
Or size of these effects would be.
They don't mean shit.
Also,
not only do they not mean anything, but
you'll be reluctant to move too far away from that just because you don't know. It's so unclear.
No, just tell them it's the politics, bro, and the Fed policy. Say it. Or not Fed policy, but Fed independence.
Inflation overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have very, very
little change. I said that to you earlier, even though the fucking articles were saying otherwise.
The U.S. economy is doing, pretty well.
It's doing great.
We don't know what the the effects of this will be, and really no one does.
You're going to find out in the next 2 weeks, bro. You are. You're going to start seeing shit break everywhere.
Suggested that higher oil prices, they have a hit to
Oh,
consumption,
the bear's talking.
but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past,
Yeah.
about
So there'll be an offset.
offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war. And
This is false.
I believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher.
Yes, but why, though? Tell them why. Because of Korea, Japan.
But some of that could happen over time if you see that. But so the net of
That's the real danger.
of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on.
If you adjust PCE, we hit 2%. We hit 2.3, but if you adjust it, it's 2.0. We've hit the fucking target. I don't know why he keeps using this thing. It's like word salad for a narrative.
It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's
This is going to be a snoozer, guaranteed. Unless there's some gotcha here we don't see.
that can cause trouble.
Vol's saying there's something we don't know, but there ain't shit. We're going to drive sideways all the way in to the close here, fade a little bit. You're going to see the next 3 days we go nowhere in a Friday. It's going to be like a road to nowhere. No major down, no major up. There's no catalyst that I can see here.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services.
What, overshooting services, not in durable goods? I thought we paid I thought inflation rose and due to tariffs.
Inflation returns to target over the next couple of years.
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it
Timmeros, you pushed that narrative too, bro.
restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to
Who's they, bro? Say it's services, not the actual goods.
consumers.
Say corporations and producers ate that shit.
For that process takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place.
Yeah, you're waiting my ass. You already know what it is.
Last year, we're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative, and then, the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like we're.
And just so you know, goods inflation is down. It's been coming down. It's been coming down from a high in September of 2025. It has not gone up. He's lying.
Not restrictive. We feel like that's the right thing to do.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued. What we want.
Here's your goods inflation.
Is continued progress on housing services.
Down.
Finally seeing goods inflation come back down because the.
What do you mean come back down? That's it right there, bro. Like it's right fucking there. It's right fucking there, man. What do you mean come back down? We were supposed to see goods inflation fucking crank up in here, bro. End of the world tariffs. Fucking bullshitter.
January, revised down February, posted a loss of 92,000.
We got fucked by services. The fact is that producers, I'm serious. If you look at business profits, they've gone down, except for financials. Except for financial companies, they've continued to go up and kept their gains since COVID. It's the only sector to have done that.
Have come down very, very sharply over the course of the past year due to immigration policy largely.
You had like goods eat that shit, and then you had service companies go, well, we got to raise prices because goods are going to go up, but goods didn't go up. Goods went down.
Inflation, you can, we're at 3.0% core. Inflation 2.8% headline, so we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for.
The law.
We've done on several occasions, including involving me, and it's what we're going to do in this situation.
Ooh.
And while I'm at it,
Ooh.
on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Well, he did rule out that he was going to leave, so that's positive.
Thank you very much. Claire Jones from the Financial Times.
He didn't just come out today and say, I'm out of here, fuck off.
The current situation, we've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today?
We're not there yet.
It's really hard to say until we see the situation.
Yeah, we're not there yet, bro. Whoever she is.
Some circumstances that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about.
VIX 9-day continues to rise, at a new high at 2463.
What has been the trend job creation over the past, let's say, 6 months.
It's about to break out. Watch out for the move to the downside here. I think I've told you that a few times here.
Effectively, there's zero net job creation in the private sector. But actually, that looks like that's about what the economy needs in terms of...
Gap is about to be closed here.
Very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay? But, you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, you know, we look at that, we see it, we get it, and I mean,
market fading, knowing that there's no catalyst to go higher.
The break even is zero, but nonetheless, it's something we're watching carefully.
Watch out for the next few questions. They're going to probably ask something extremely hawkish or bearish of Jerome.
Deliberate policy, which is really the changes to immigration.
VIX is breaking out right now on the 9-day. It's about to explode to the upside.
Thanks, Chair Powell.
Looking to trade 25 and a half.
COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank...
Be warned here, we're going to explode to the downside in just a few moments. Watch out for a bloodbath down.
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question.
VIX 9-day breaking out right now.
The 2 parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay.
A little bit more gap to close down here.
Communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So
you're going to find out in about 2 weeks.
A number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
Watch out for a bounce.
Has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
if there have been any discussions about the risk of stagflation,
stagflation
scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation for, a much more serious.
We're not in fucking stagflation. We're not even near stagflation.
Some tension between the goals, and we're trying to manage our way through it. It's very difficult.
All this noise about stagflation and employment's horrible.
I reserve stagflation
No.
for that, the word for that period. Maybe that's just me.
It's all fucking bending data.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food?
Not yet. You got to wait 2 weeks. You got to wait until the breakdown.
These effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices.
It's not 2 weeks. It's a week and a half. We're at about a week and a half right now.
Isn't for a long period of time.
I said 2 weeks, but it's about a week and a half. The finish of this week and the finish of next week, and things will start breaking.
That would sound like I have some idea of what
We're at 19 days, I think, so 10 days from now.
this works out. And I just
About 10 days, you'll start seeing, or we already are seeing it. The exports of jet fuel is being banned right now in China, Vietnam, Laos. You should see announcements over this weekend and then next weekend.
How the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance?
No, that ain't happening, dude.
Lead you all to move, or is
Well, maybe it's slightly over 100, but
we'll have to wait and see.
they're going to wrap this shit up in 2 weeks, maybe 3.
We always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about.
They're going to break those fucking lasers out that they broke out down in Texas on the border with Mexico and the coast of Iran.
Just remember that we don't.
That's what they're going to do.
And we shouldn't assume it's going to be one thing or another. We're going to see.
so is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact,
They want him to say that he's going to raise rates at the next meeting. That's what they're trying to get him to say.
has really been just
We're raising rate. We're going to a hiking cycle next meeting. I'm going to be with you all summer long.
Again, I don't.
That's what they're trying to get him to say.
Intermeeting cycle.
Gotcha.
At least I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves.
What are you talking about?
Some of the tariffs that were overturned. So I suppose I'm curious.
Fuck do you mean you don't know? We have fucking tariffs going since fucking the beginning of the United States. We have historical fucking answers to this. What do you mean nobody knows?
I'm not certain. I'm uncertain. But just
What the fuck is she talking about?
it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And
he's telling her she doesn't know what the fuck she's talking about.
They cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think
stop reading Reddit. That's what you should just tell her. Stop reading Reddit.
Takes to get all the way through the economy is just very uncertain. And we found coming out of COVID that the inflation did go away.
You should just say that to her. Listen, stop reading Reddit.
So I think we
stop reading Reddit and asking me questions.
How long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see.
No.
And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the.
Tell them that the inflation you're going to see is historic inflation, Jerome, or you got to wait until you get out of office to write that book. That there's nothing you can do about it except blunt it.
They'll do that over time. So that's how we think about it.
He's like, I can't tell them that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted you talk.
VIX 9-day breaking out right now, cranking.
I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's.
Tell them it's gambling, Jerome. Tell them it has nothing to fucking do with the actual rates.
On events, sometimes very quickly. So it never locks people in. People are.
Tell them the dot plot is horse shit. It's for gambling, bro.
So I just think we do it, and I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to.
Yeah, grain of salt. Yeah, there you go. Tell him, Jerome.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that...
That's false, too. This guy's saying false shit, too, here.
I'm not sure.
Except for the bottom 15%.
But I'll tell you what I think and what I see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic.
And we pay everybody more now, too, for it, bro.
Real wages have been going up in the United States.
That's right. Tell them.
Roughly. But people are not feeling like...
They don't feel like it.
And it will
Tell them why. Because the class above them is breaking away from the class below them.
But you're right. But when you talk to people,
so they're pissed.
Do feel squeezed, and they
feel.
Areas where prices are still going up, like insurance, various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to the price, into the price. So
no, that's false.
Very seriously, we don't dismiss it at all.
Tell them that financial services and insurance never coughed up the profits. They're still enjoying them today, Jerome. Tell them. You're not gonna though, because you're a banker. You're not gonna throw your own people under the bus.
Inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates. Maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see.
Watch out for blood into this bell here. VIX is cranking. It's about to explode to the upside. VIX 9-day is. I'm not watching the 30.
Do the things when we need to do them to preserve price stability, and it's an accepted standard.
The 30 is what's up.
A lot of support, certainly in Congress, which is where our oversight is in Congress, and you see that among Democrats and Republicans.
Or what matters to intraday here.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long for the committee to consider hiking rates?
Oh, dude, stop with the hiking rates, guy.
Rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you
no
example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what.
Yeah, he's like, just say you're going to start hiking rates like right now, bro. Just say we're starting a rate hike cycle.
Are we concerned about it? I mean,
how concerned and whether or not it will.
What about concern, bro? You have concern about starting a rate hiking?
Really rely on it to.
So I think it's a more general.
Look at there's a woman in red in the wall, and she's got a big shit-eating grin on her face.
Just lots of ways that
she's like
derivatives of oil get into the production and transportation of.
It's like he's not gonna fall for it.
So, and those, there are big effects in headline inflation, but things like that leak into core as well, and the effects may not be as big, but they're quite real and they're material. So we are aware of that, and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Archie, for the last question.
Thanks very much. Just stare into the future for a little bit. I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from
up. Archie, tell him up.
Long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years.
We're constantly tell them that it's constantly going up productivity, bro.
Things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage, but
we don't have people shoveling coal in mines anymore in the U.S. That's what corporations exist for, right?
Because they're so rare, and they're often revised
to increase productivity, bro. They work on it every day.
I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So. It's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time.
I don't know about in the future, bro.
Yeah, no, I was just curious what lay behind that, and just briefly to.
There's gonna be an intersection of that hurting everybody, not today, but soon.
If you believe
that productivity thing. That should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question, because really, is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Okay, that was a big nothing burger there. We're getting roped into OpEx here. Friday's expiry. Let me mute this real quick. And we'll take a look at the market together if you want an outlook for the rest of the week here. Let me just get rid of this here. Hold on. Man, I hate deleting all this stuff to redo this stuff every time, but we got to do it every day. So we do it twice a day on the show, and then I do it at nighttime at 9 p.m. and then in the morning as well before the open. Let's go to this really quick. Okay, so that's a big nothing burger, like huge nothing burger. Nothing shaking the market here. There's no gotcha for the downside move. There's no gotcha for the upside move. Huge nothing burger today. They tried to coax him into some stuff. And I'm watching the VIX in the background here. The VIX is staying primed for a squeeze higher with no catalyst. So that tells me that with no catalyst and this VIX is primed here, that the market is is now shifting gears right away into this quarterly OpEx kill all options kind of a trade here. So we're going to talk about this. We're going to talk about the next couple days here, like today, tomorrow, the close. Let me get over here to. We'll do this together because there's a lot of you here. We'll try to make it as fast as possible. I'm going to show you this 3-month really quickly here. It's 356 and change. Let me see if I can. Give me a second here, guys. What the market is trying to do here is trade lower. Here, let me. We'll do it again. We'll do it again as we did it this morning. I'm just going to show you briefly here a 3-month. This is a 3-month candle. Okay, so if you're just joining us or you don't watch this show regularly or anything like that, you want to be watching this 3-month candle right here. Now, there's a thesis out there. The greater market has this thesis that we are going to trade. So in this 3-month candle that we're likely going to trade down into 620, 6,000. Backtest all this, drag around, and then maybe make our way higher. For that to happen, we need some specific price action above. So what you normally do for that door to open is you want to look at this prior quarter. This prior quarter is right here. This full candle right here, you can see it right there. And then you want to take about 80% of this candle. It's 5.1. Right about there. We're going to snap this line in. You can write this number down at home if you want. It's right there. It might be a little bit lower. Let's go down here and take a peek at it. Right about there, right there. Right in that like 516, 556.80, 556 or 657.96, somewhere in this vicinity here. And we want to watch as this number right here is important. And there's a reason I want to get to this here in a minute. Why this is important. If you take away where these buyers were, right? You slam down here, it's telling you that sellers are stronger than buyers. I know you don't want to hear that, buyers, sellers stronger. But you take these guys, you dip into these buyers, and it's showing that sell side is weaker or stronger than this buy side. This original group of buyers right here opens up the door to at least sweep that 3-month candle, and if not, open the door to even more downside. It brings into question if these buyers are even here. So you go to a 1 month, and what I want to show you where the trap is over here. So the 1 month is right here. This is your 1 month target right here. And so I think a lot of bulls think, I think a lot of the thesis here from bulls is that, I'm going to put that one right there. We're going to switch over to the week. And the week is right here. I think bulls basically think, hey, man, if we just get down here, bro, if we just get down like 648, 649, you're going to see a resolution from this war or whatever, and the market's going to, get down here, and then everything's going to be honky-dory. We're out of here. Everything is great. But in fact, underneath the surface of the market, to get here, there is a trigger down here that is a bull trap. No matter where we go, not no matter where, but there's a bull trap down here. If you tag this one down here, you hit this number that everything, the coast is cleared. In fact, there's a cross right here, and we're going to start making some even deeper lows. So you need to be aware of this like 657.96, 656.90 or something, 87 or something, roughly in this vicinity right here. If we graze this and we slap this down here, it's telling you that any return up is going to be sold. The triggers are also telling you that same thing currently. You can see where this weekly is. What'll happen was that you'll see this cross here, and you'll see this cross down here. So you're like blasting down here, right? Oopsie, right? Back down into here, and then all of a sudden you're trapped in, and it's wham down to some even bigger lows. So when you hear people say like, I think all this week, if you've paid attention closely, everybody is like, or I'll bring it back to a 1 hour candle here. Everybody's looking for this big dump, right? This big dump down here. And the reason they're looking for that is not to hit this or to hit this. It's to hit this one. Because you open that door, and no matter what happens here, and I'm showing it over here because they're setting it up. They set it up here, they set it up here, and they want that new low, basically. And there's a few more setups for this. There's one more over here, and there's one more above here to try to hit that thing down here, hit that thing down here between now and the 1st of April. No matter what we do, if we get down here, and we go up, we're still going to start heading to the downside. So just be very conscious of not so much this target here or the gap that's down below, but be more concerned about this white line right here. This white line does not open lows to right here. This white line opens lows to 640s and more than likely 620s and 600s. So just be extremely careful when you hear people say, like when you hear a bear, I don't want to use the bear terminology, but whenever a bear's like, we need to go down there and close that thing, bro, before we go there, they're not telling you. You might be saying that because you want to get paid there, but there are smarter traders that know if you go to that place that it opens this bigger, much bigger door to bigger downs. Not necessarily right away, but you need this to happen for that to happen. If A happens and B doesn't happen, we can't get to C. So you need that B to get hit as well. So this is a big thing down here, right? And everybody seems to know it's happening. You probably have heard in the news, everybody's saying, well, we haven't gotten what we want down here. We haven't gotten that big capitulation. My hedges need to print. Hedges are expensive. I need it to go down, bro. But in fact, there's actually something hidden in here as well. If you go down here, it creates even more selling begetting selling. So let's take a look at what to expect in the next 3 days. We're going to go to a day. We're going to go back to this weekly really quick and take a peek at this. And as this week progresses into Friday, every day that passes, I want you to pay attention to this other upside white lines that I post in right here. There's one right here. And this is for the bulls. If the bulls are like, hey, I want to see, we shouldn't do that. Oh my God, I want to see the market recover, blah, blah, blah. The buyer's like, I just want this to turn around. No more death and destruction. Your upside numbers currently in the weekly are 674.99 and 672.63. And that will continue to go lower. That white line, those two white lines above, you'll see those go down and down and down. They're just shutting doors on you. They shut the doors on the 80s, and now they're shutting the doors on the 70s. Even with a squeeze up to the 90s up here. Even with this squeeze up here to the 90s. And I'll show you the rest of that here in just a minute. So here is the weekly. And then we're going to look at the daily over here. And this is where the key part is right here. There's a little daily right up here. On a daily basis, in case we squeeze, let's say we come down here and we squeeze, bam, hit that bad boy, and we squeeze. If we can just stay in here for April, it's still down. It's like a down in a big way. We could roll here or up here. And in both cases and scenarios, because we took out this one, the way is still lower. There is no escape. Well, there can be, but more than likely, the percentage of chance that you can escape this goes way down. It's like boom, 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 boom. So be conscious of that as we move forward in this market. Right here, we're going to put on this daily basis, we're going to slap some lines in right here. This is red. I drew this in already for the show earlier, so some of this might be repetitive to you. We're going to pop these two right here. This is the no-go zone right now. No going above this. And every day this gets worse and worse and worse. By the day. Here's one right there. Here's another one right here. If we break above this 674.99, these dailies become weaker. So we're gonna make them yellow. This is where all the sellers are down below. Every day. No breakout high enough here to escape. And I want to show you this here. You've got hey, let's get out of here, right? Let's get out of here. Let's get out of here. Let's get out of here. Let's break this one right here. Can't break it. Break that one. Can't break that one. Didn't break this one. No catalyst positive. Coming back down now to recheck these buyers right here. Closing the gap on the downside. You see the gap being closed right now, right? These buyers right here become questionable and suspect. But we're in QOPEX, quarterly OPEX. We're now on a 4-hour, right? We've got a 4-hour candle right here. You'd expect this to be the top right here, 665.24. So you've got the 4-hour candle ending right now, right at the end of the day, and you're going to get another 4-hour candle after the night. You're going to get another 4-hour candle in the morning. You're going to get another 2 4-hour candles tomorrow. Put this one right here. 4. This one becomes red. You're trapped in now. You can't go nowhere. But wait a minute, go back to that 4 really quick, just to make sure. This is looming. You're not getting this. I'm just going to tell you right now, you're not getting that. It's going to be like dangled like a carrot down there for you, but you're not going to get it. Right in here. And also I just want to see this here. Look at this. This is a 1 sigma move. We are now coming into a 2 sigma downside move on FOMC with nothing negative being said. Means that we're being dragged into an OPEX, quarterly OPEX, right? You can tell crystal clear here that we're being dragged into the vortex of OPEX. A gap has been closed in cash market. You're now going to look at the last place that the smart money is right here. This was the instigation of the move. You go to the next green wick. It's right there. Right there. Let me just make sure I got this right. Try to get the tick on this right there. Right there. You should see more weakness into this bell. The target on the downside is 662.20. This is the close right here for 1600. I just got to be able to draw this shit in really quick. I'll remove these lines in just a minute. This is Thursday right here. 1600. This is Friday for OPEX. Right here. And I'm going to tell you right now what I think happens here. You're going to get pinned in right here. Wham, 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 wham. And I don't see us going anywhere. And then I see us, the unwind is thereafter, okay? This is your basic, what you're going to expect right here. Nothing. I don't see us going plunging down here tomorrow and triggering that just yet. What I will give you between now and then is the new low down here and some 660 action. So I'm going to tell you that there's demand here. And we have the new low down here. This is exactly what you should expect from now into Friday. Just like this. I want to show you how you're going to get trapped in here. This is 2 o'clock on Thursday. Right there. You should see a recovery tomorrow morning. It'll look really bullish, and then you're gonna see option sellers attempt to sell down in the close, and then drive sideways into Friday. You won't be allowed up and out and away. On Friday, you can see a squeeze up at the closing bell, or on Monday. Now, this is kind of wonky here to be drawing to 670. Where's 670? Right here. You'll get this return on Friday, but I'm going to draw it for Monday, okay? Just because of the drawing lines like this is kind of wonky. So I'm going to draw it just like this, and then I'm going to come back here, and I'm going to go just like this. But it ain't going to trade like that. It's going to trade more like... It's not going to trade like this, but I'm going to draw it like that. It's like this. Just like that. That's your expectation. Now remember that this is going to drag ass. You're going to get bounced down here and then whoop, right up something just like that, okay? Don't expect too much in here except for dragging ass. You could get the unwind at the end of the day if you wanted, or maybe on that Monday you get the explosive unwind to the upside. Thereafter, after this, just so you can see this right here. Here's your daily trigger. And they're going to try to trap this in coming right into Monday, Tuesday of next week. There's your high, right, for Monday or Tuesday. And they're going to try to send you right back down in here. Hold on here. The attempt is going to be to send you right back down into this 30th over here. Well, the bigger question here is this. I want to show you the bigger question. Let me just get rid of this. Look, this looks wonky. The sellers are going to try to keep us down. Here's the 30th. So you have the OPEX pin for in here, quarterly OPEX pin in here, and just try to keep us pin in. Now, there's something important here that I want you to realize or know about. This is your 690. There is a good chance here of some kind of a squeeze into the beginning of the month for liquidity. So see this April in here. If the market can trade up into or above here, what they'll try to do is try to get us up for rolling of hedges on the 31st. But the real problem here is when you get the dealers chasing that, move down, you get down just enough, right? Dealers will counteract that trade, and then we'll start making our way down to really start making those lows into middle of April. Just note too that this can all be blunted. This can all be down here. They'll be coming in this. They're just like they came in and sold right here. They're going to come in here and sell this. They'll sell this over here, and this is going to give the opportunity, no matter the outcome on Iran, to be selling selling equities and buying volatility on any of these highs in this vicinity up here. Just note here that your major sellers are right here and right in this zone right here. You get it? And then no, you're not crashing. No, you're not going to do any of that into OPEC, quarterly OPEX. They're gonna wrangle this. They're going to make all options go in here to die. They're going to murder all these options. They're going to do it again when they do the roll. They're going to murder a bunch more options over here. And then they're going to be looking for the best price to sell April to the downside into the 15th. And I just want you to show you what this looks like here for the downside into April. Your big time low should be right in here. And you can kind of see it now. This bad boy, as this crosses, let me just draw this in for you. Make this nice and thick. This is your weekly trigger right here. This is your daily trigger coming down right here. And it's going to get nasty. So you can see that right there. Come up in here. Maybe they snap a little high up here, but it's still to the downside. You see it? Now you see it? It's like bad. You know, it's like wham, 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 right? That kind of stuff over there. Wham, 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 wham. Fuck around in April. It could be a fuck around in the mid-April up here, and if things get uglier, we could take it into May. Come another one over here in May, and then wham. And now you're creating this new trend to the downside, just so you can see it. There's like a big-ass like trend to the downside. We're not there yet, but just be aware that if you're on sell side, wait a minute here. If you're on sell side, just remember these big squeezes here. Do you see this big squeeze? See that big squeeze right there? So if you see some kind of like nonsense up here like this, or even later, they smash us down here and then a big, big giant up. Just remember, I want you to remember this group of sellers right here. So this group of sellers, right, they want that payoff. And this group will move down here and down here to sell this even deeper. So just remember this group over here, that the smart money sellers are up here and they're down here as well as time ends up passing. So there can be some other highs up here, but even so with those highs up there, just remember, get rid of that for right now. We don't know what that price action in real time is going to be. And I don't think that you need this 57 at this point. You do need the new low, which you're going to get. You're going to get the new low right in here. You see that? That's the new low. That's really the inflection. The only inflection that you need is like ping this thing out, make the new low, and then we're out of here. We get sucked up into this OPEX, quarterly OPEX on Friday. This is Friday. This is Thursday. And remember that this shouldn't happen on Friday. If you're like, oh, Cap wrote Thursday up, it's more like grind down, back up, send it back down over here, and then something like this. But I'm just drawing it so that it's one on a hourly basis. It's just cleaner like this. Make sense? Like if we're in a trend on an hour, we can trade all of this right here. Trade an hourly trend. It's like this, like that, just like that. Okay. There's a range within this right here. Whoop, sorry about that. I fucked that up. So here are your expectations. The other thing you want to see is watch this right here. This hourly trigger will stay up. This will come violently down just like this, and then it'll come right back up with trend. Just watch this closely, right? There's that hour right there. And there's your cup and handle after OPEX. Right, here's your cup. Make the new low. Here's the handle. Bounce it down. Grind on 63. And then finally the release over there. so you can all see it. Market bleeding on no news, all tied to not Vixperation, to all tied towards quarterly OPEX here. SPOOs retesting the market low. Should I bring it over here so you can see it? That might help. Looking for a break of this low right now. If you're a sell side, you don't want to be short here anymore. Let the FOMOers do the job down here. You don't want to mess with that. They could easily squeeze you up, so don't mess with this if you're a seller. You want to get the fuck out as we make this low right here. So you can see that. Don't mess with this stuff down here. You want to get out at this point. You want to observe and see if we actually catch the new low so that you can get the handle over here to get down. Bring it to a 1 minute. Let's bring that up. 2 Sigma move starts at 661.30. That's where the new low is right here. They're not going to do this right now. Even if they do, it doesn't matter. It'll immediately ricochet up. The moment that you come down here and hit that thing, it's going to go violence. It's not worth the trade. There's a bunch of buyers right here. Not a good look here, boys. There's one more thing to let you know here. For the sell side, we are out of range. We are out of range. There's still another chance on end of month on the 31st of March, but the fact that we are this low out of trend is what needs to happen to break the upside trend that's been going on. I don't know if I could. I've already shown that shit too many times. I don't need to show it anymore. But if we can keep down anywhere down here, pin down here into the end of the month, we will be far enough out of trend to break away from that upside trend. You would expect, listen to me closely here, you would expect, mark my words on this, between now and the first week of April, if we're still out of that major trend and far enough away, once we start rolling those hedges, if we start rolling those hedges, you can just mark on your book 620 and 600, and you will sell the month of May. If we haven't been selling the month of May most years, April you'll sell that, and you'll more like you've got April would become like a 65 to 85% chance. Selling May would be 35, and it would move into 50 to 65 into May to go down into the 600s. And you'd get a Fed put down there too. There would definitely be a Fed put down there, but the door is closing is my point. The door on bulls is closing. major trend being broken and held into end of month as of today. You likely don't see that capitulation, though, until not the capitulation here, not 657, but the capitulation down to like the 40s and 20s and stuff. That won't be until fucking April, late April. If not later in May. Like, it'll take into like April, May to get down there. And this thing is like set up to do this. It's set up to do the, just so you know, that 57 number. We're set up to trade that today, Friday, the Monday after Friday, and then the end of month and the first week of that month. So they've got 3 more good opportunities. And sellers are looking for, I mean, I know they shouldn't be looking for this. Like, it's horrible to say this, but they're looking for like boots. You should, like, if you're looking for like boots in the ground, it should come like this weekend, next weekend. You should start seeing like over the weekend, you should start seeing like, hey, we deployed this, we deployed that, that kind of stuff. If you're looking for like, when do the troops get, when do the troops publicly be announced to be on the ground? You're going to see that on either this weekend or next. You should hear about that this weekend or next. And that should, like, I think that would send us down to 57 and get us where we need to go to close the door here. And then you'll get like that Trump thing where he's like 3 weeks, 2 weeks. That should be coming in right around that that last chance for sellers on the month end and the first week of April. You should see like a little high up there, and either in the 90s or in the 70s, somewhere in there. Do note that there is squeeze risk here. I think McGilligot said it, Pravorsky, Rubner. If the real big squeeze like has the most kinetic energy, it's likely at the 57 number down below. Putting around here into the bell, not much more to do. Be careful next if there's like any kind of like anything to say to you like top line. Careful the next couple days. Is that we drive sideways tomorrow? We generally speaking like drive sideways tomorrow. Drive sideways on Friday. Literally no movement. I just sold a bunch of spreads. You should be able to sell spreads here, and like nothing is going to happen over the next 2 days. This market should become boring except for single stocks. And tomorrow I will have the list for you in the Discord showing the most the stock, anything that you know that's gone up, like vertical up in this whole quarter, should come down violently. Anything that's gone violently down should squeeze up, at least a few of them. But the indexes, I wouldn't expect that to happen inside the indexes for where we are. Just grind sideways in the indexes, do nothing. It was nice having you here today. Thanks for coming out over for FOMC day. What else do I have for you guys? VIX 9 days going up right now. Well, that's all. I think that's all that I've got. We're looking for more highs to try to buy vol at some point. I think that's the bigger thing here is for where we are. We're looking for big highs here in between now and the first week of April. Something to sell in a big way for the month of April and May. We can't do it yet either. We need to have that 57 get broke. Is it 57? Or excuse me, I'm saying 57. So yeah, 657, 658, somewhere in there. If we can get that thing broke, you're looking for a huge high to sell. We haven't broken it yet, so there's nothing really to do there on that stuff until that happens. And they've got it set up. You got like multiple opportunities to get it done. Not many more. If they can't get it done, we don't know this yet. So if they can't get it done, then the bear case starts to look a little pathetic. You're like, yeah, they got 1 chance, 2 chances, 3 chances. Now it's all riding on the beginning of the quarter, but we're not there yet. So, but they do want it, man. You got a chance on Vixperation. You got a chance on FOMC. Like the Bull Bears write a book. You know, it's like, here's your Vixperation. Here's your OPEX. Here's your month end. Here's your weekend of Army and Marines kicking ass and taking names. That we lose an aircraft carrier in the Gulf. And it's, you know how this turns out, right? Don't get too bared up here if you're a bull. The book that the bears write, they write these books, and before you know it, the time crunch. It's either time or price. You either get the price, or time just goes away. All of a sudden, volatility is wrapped up with a nice bow, and the market's just going vertical for the spring and summer. So don't be like, oh my God, it's the worst thing ever. If they can't get it done, this will all unravel, and we'll start cranking to the upside. All of a sudden, everything's solved in the Middle East. All of a sudden, all these windows of opportunity for sell side if they can't get it done on the 2-yard line. And all of a sudden, we're just heading higher at that point. So the Bears still have time. They had today, they've got Friday, they've got the last day of the month. They'll get another shot as well in mid-April if we haven't had any improvements. With what's going on in the Middle East. And the only other bearish thing, or if I had anything bearish to say to you here, and there's one other thing that they have, and that is the longer that this goes on, there is real damage being done, not to our economy currently, but to economies that matter to the United States. And no one talks about this on the news. I don't know why it's being downplayed still to this moment. We discussed it here in the show earlier in the week. And I think we discussed it on Friday, and then on Monday we discussed it, I think. And that is that forget the fertilizer. The fertilizer doesn't mean shit. What really matters here is you've got manufacturing plants, manufacturing fab plants, a bunch of shit like that gets made. And I'm not talking about like NVIDIA chips. I'm talking about other chips. In Japan, in Korea, or South Korea, in Japan, and in these other surrounding states like Laos and whatever. And those are the internal things. Those are the internal things that make the other things work. Like we might make a phone, let's say in China, but there's some little parts in there that come from these other countries. And these countries are going to have to start sacrificing. And I don't know why they don't talk about this that much. I don't hear about it anywhere. And that's where the real danger is, that you start shutting down foundries. You start saying, hey, are we going to stop selling? Like they have things they can do, like, oh, we're going to stop exporting jet fuel from our country. But then you're going to start hearing things like, over the course of the next couple weeks, you're going to start hearing things like, hey, we're going to have rolling blackouts because we got to keep the foundry running, or we're going to turn this foundry off and do permanent damage and keep the lights on as this continues on. And I think that brings up a bunch of other stuff too, which is it a weapon of mass destruction? And what is the playbook for the U.S. in those situations? And they say like our partner is Israel. Our partner is much bigger than that. Our partners are trade partners in Southeast Asia. So as every day goes forward, and every day that fuel, that diesel, not in the U.S., but the diesel in those nations that they power, all, like you got to understand that like the dynamo that, let's say, Korea is, or the dynamo that Japan is, they have no fuel. It all comes, 80% of their fuel comes through that strait. 80%. And there will have to be, you'll hear this news too. I was talking about this last week, and then you heard it on Sunday about jet fuel, and you'll hear more of this as we get into this weekend, going like Friday, Saturday, Sunday. You're gonna hear more like, hey, we got to start. We got no fuel. Like we're kind of starving over here. And you're going to hear that next weekend as well. The more no resolution from the Strait of Hormuz opening. Just be aware of that as we head into this weekend and next weekend. All of these things that should start to cascade, and then you'll start to see the blood, like the real blood. You'll start seeing that real blood in April. You start seeing the real blood in May. like big major downs in the market. And now that stuff does impact us. I was listening today to Jerome, and one of the questions he got today, which was like, "Oh, is it because of diesel?" And I'm like, "No, it's not because of that. It's because you're gonna fucking turn off the tech that isn't the sexy tech that goes into a lot of your stuff that comes from Japan, that comes from Korea, and do some serious damage. Like you're either like you're making a choice between brownouts or keep a foundry running. If you shut down these foundries, it does permanent damage to the equipment, the machinery inside of these plants. So there's real risk and danger. Forget fertilizer. Fertilizer ain't got nothing on that stuff. Food shortages. We get the world's breadbasket. We literally throw away in this world like half our fucking food. It's the fucking machinery and the manufacturing that's the problem. And that can have some serious consequences across the world. We're not there yet, but you know it's breaking. You can see like the little pieces breaking and stuff like that, and it'll become headline risk at some point. It's 4 p.m. We're done here. I'll see all of you guys tomorrow at 9:30 in the morning, and I look forward to seeing you tomorrow. Don't expect too many fireworks today and tomorrow. We should just start grinding. If you're looking for fireworks tomorrow, look for single stocks. Single stocks is where it's going to be at the next 2 days. I'll see you.